Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. I want to note that for the record that due to the COVID-19 pandemic, today's meeting is open to the public through a live webcast only. The public may access the meeting by visiting the agency's homepage at www.ncua.gov and clicking on the provided webcast link. Additionally, presenters in today's meeting are participating remotely. So if we experience any technical difficulties, I ask for your patience. The first item on our agenda today is the Share Insurance Fund 2022 Normal Operating Level. Staff presenting, David Blanchard, Acting Director of Risk Management, Office of Examination and Insurance, and Russell Moore, Risk Officer, Office of Examination and Insurance. Staff available for questions include Myra Tepe, Director, Office of Examination and Insurance, Vicki Narwald, Associate Director, Office of Examination and Insurance, and Andy Leventis, Chief Economist. David and Russell, you may begin whenever you are ready.
Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. Risk Officer Russell Moore and I are here to brief the NCUA Board on the policy for setting the normal operating level final notice, the results of the Board's May 2021 request for comment, as well as presenting the results of the normal operating level calculation for 2022. We will be requesting Board approval to 1, adopt a policy for setting the normal operating level outlined in the Federal Register final notice, 2, publish the final notice in the Federal Register, and 3, set the normal operating level at 1.33%. First, I would like to discuss the normal operating level for the Share Insurance Fund and how it relates to the Share Insurance Fund's equity ratio. The normal operating level represents the desired equity ratio for the Share Insurance Fund and is the point beyond which excess equity is returned to the credit unions in form of a distribution. Under the statute, if the year-end equity ratio of the Share Insurance Fund exceeds the normal operating level, less any loans and associated interest to the fund from the federal government have been repaid, and the Share Insurance Fund's available asset ratio exceeds 1%, then the NCUA must return the excess to credit unions. In addition, the Federal Credit Union Act requires the Board to set the normal operating level not less than 1.2% and not more than 1.5%. In December 2019, the normal operating level was set for 2020 at 1.38% based on the policy adopted by the Board in 2017. The normal operating level was not changed for 2021 and remained at 1.38% for 2021. The current policy for setting the normal operating level as approved in 2017 states 3 objectives. The first objective is to retain public confidence in the federal share insurance. The second objective is to prevent impairment of the 1% capital deposit credit unions can contribute to the fund. Finally, the third objective seeks to ensure the Share Insurance Fund can withstand a moderate recession without the equity ratio declining below 1.20% over a 5-year period. That's the level at which we would require to charge a premium or implement a fund restoration plan. The goal of the policy is to be able to avoid premium during economic downturn and recovery when the credit unions can least afford it. The policy also establishes that any change to the normal operating level of more than 1 basis point be made after a public announcement of the proposed adjustment with the opportunity for comment. Russell Moore will now discuss the results of the request for comment.
Thanks, David. This is Russell Moore, Risk Officer in the Office of Examination and Insurance. The Board sought public comment on the policy for setting the normal operating level of the Share Insurance Fund and our approach in implementing policy in our calculation. The request for comment published in the Federal Register in May included 9 questions for the public's consideration. Typically, questions solicited input on important concepts such as the use of a moderate recession, appropriate data source, duration of calculated performance, ongoing decline of the equity ratio, and the use of qualitative factors in calculating the normal operating level. Additionally, questions included requesting input on how the residual risk of the corporate asset management estate should be considered, if at all, when the normal operating level methodology should be reevaluated, and what incremental change in the normal operating level the NCUA board should solicit public comment. Commenters were encouraged to discuss any other relevant issues for the board to consider. In response, the board received 23 comment letters from credit union leagues, trade associations, credit unions, and credit union service organizations. The NCUA formed an internal working group to review comments, develop responses, and recommend appropriate changes to the policy and its implementation. The working group consisted of policy experts from the offices of Examination and Insurance, the chief economist, and the chief financial officer. I will now summarize the comments received in working group responses. Based on the majority of responses, commenters favored continued use of a moderate recession as the basis for evaluating the Share Insurance Fund's performance, continued use of the Federal Reserve data as the basis of the moderate recession, modeling the performance of the Share Insurance Fund over a period shorter than 5 years, eliminating the calculation factor based on the modeled potential decline in the value of the Share Insurance Fund's claims on the corporate asset management estates, eliminating the factor for the projected equity ratio decline through the end of the following year without an economic downturn, and retaining the requirement to submit the normal operating level results for comment whenever it changes by more than 1 basis point. Commenters were generally opposed to reevaluating the normal operating level during an economic downturn or during an abnormal event such as the COVID-19 pandemic, and any efforts to lift the 1.5 statutory cap or allow for premiums if the equity ratio was above 1.3%. Other miscellaneous comments received included changing the accounting method for the Share Insurance Fund and setting the NOL at 1.3%. The working group agreed with the majority of the comments directly related to the policy for setting the normal operating level. The working group disagrees with using a period shorter than 5 years. The working group recommends continuing to use a 5-year modeling period as the basis for the normal operating level stress scenario. Continued use of the 5-year period is supported by data from the Bureau of Economic Research, the not-for-profit organization that establishes the beginning and end of U.S. business cycles. The working group does not agree with arbitrarily setting the normal operating level. The working group recommends continuing the current standardized process based on the risk inherent in the Share Insurance Fund, except as noted later. The comments relating to raising the statutory limits for the normal operating level and changing the accounting method of the Share Insurance Fund are beyond the scope of the request for comment. I will now summarize the working group's final recommendations based on our analysis. The working group recommends the board retain the current objectives for setting the normal operating level. When setting the normal operating level, the board will seek to satisfy the following objectives: retain public confidence in federal share insurance, prevent impairment of the 1% contributed capital deposit, and maintain the Share Insurance Fund through a moderate recession without the equity ratio declining below 1.2% over a 5-year period. The working group recommends the impact of changing the value of the corporate asset management estates and the decline in the equity ratio through the end of the following year without an economic downturn be removed from the normal operating level. The working group also recommends the board continue using a decline in the Share Insurance Fund's equity in a moderate recession to estimate the additional equity needed to prevent the equity ratio from falling below 1.2%. Finally, the working group recommends the board retain notice and comment for any proposed change in policy or any change to the normal operating level of more than 1 basis point. That concludes our request for comment and our recommended changes to the policy for setting the normal operating level and its implementation.
Thank you, David and Russell, for your briefing on the policy for setting the National Credit Union Share Insurance Fund's normal operating level, and for underscoring the importance of maintaining a strong fund, which is essential to maintaining confidence in the cooperative credit system. And thank you, Myra, Vicki, and Andy for being available to answer any questions. Vice Chairman Hauptman and Board Member Hood both offered thoughtful changes to this final policy statement. I thank my colleagues for their contributions. As members of the NCUA Board, one of our most important responsibilities is maintaining the health and stability of the Share Insurance Fund. With nearly $21 billion in assets, this fund ensures the savings of more than 128 million Americans. The fund guarantees more than just accounts or balances on a spreadsheet. It protects the financial well-being and dreams of families, businesses, and communities who have placed their faith and hard-earned nest eggs in credit unions. These members from all walks of life are counting on the NCUA to make the right decisions in managing the fund and ensuring its continued resiliency. It is a sacred duty that none of us can waver from. Setting the normal operating level is a critical part of the board's management of the fund. As former NCUA Chairman McWater said when the board last considered the policy for the normal operating level in 2017, the NCUA must be mindful not to hold too little equity in the Share Insurance Fund, with the corresponding risks that premiums will be necessary when credit unions can least afford them. Nor should the NCUA hold too much equity, which could lead to underutilization of resources within the credit union community. Instead, the goal should be to have a reasonably prudent level of equity consistent with contemporary risk exposures to fulfill our duty in managing the insurance fund. Much has changed since 2017, but the wisdom of his statement still holds true. In May, the agency issued a request for information to aid in determining how the normal operating level should be set going forward. In addition to considering current economic conditions, the working group also considered the feedback of credit union leagues, trade associations, credit unions, and credit union service organizations. After carefully weighing these comments, economic forecasts, and credit union performance, the working group recommended an updated policy that produces a new normal operating level of 1.33% for the Share Insurance Fund in 2022. Many within the credit union system undoubtedly wanted to see the normal operating level return to 1.3%, where it has been historically before the temporary Corporate Credit Union Stabilization Fund was merged into the Share Insurance Fund in 2017. In normal times, that might make sense. However, there is nothing normal about what we have all experienced for nearly 2 years because of the COVID-19 pandemic. No previous recession or financial crisis that I have seen in my lifetime has caused such fundamental shifts in the way that credit unions provide services to their members and to the ways in which we live, work, and interact than this global pandemic. Yet we must acknowledge that much uncertainty remains. From an economic perspective, the unemployment rate was 4.2% in November, an incredibly low level by historical standards. Yet, 3 million workers sit on the sidelines and out of the workforce. Supply chain disruptions continue and will likely last into next year, placing additional stress on consumers and businesses. And as the Federal Reserve has noted, the rise of the Omicron variant could slow progress in the labor markets and intensify supply chain disruptions. Additionally, for the first time in more than 40 years, Americans must deal with inflation. This is especially true for our nation's poorest households, which were hard hit by the pandemic and are now seeing increase in prices for essential goods and services. Higher inflation has led the Federal Reserve's Federal Open Market Committee to announce that it will remove its monetary policy accommodation earlier and more aggressively than initially expected, boosting short-term interest rates. These economic challenges will place additional stress on household finances, and that stress could lead to rising delinquencies and charge-offs at credit unions in the coming months. With this uncertainty, it is essential that the Share Insurance Fund remains strong and prepared. I remember when it was not. Less than 15 years ago, the Share Insurance Fund teetered precipitously close to danger in the wake of the collapse of faulty mortgage-backed securities. The temporary Corporate Credit Union Stabilization Fund allowed the system to absorb and pay back those losses over time, but it also led me to conclude that we should strengthen the Share Insurance Fund to prepare for the future. The staff's recommendations to revise the existing policy based on changes in the system and set the normal operating level at 1.33% are prudent. This revised policy will continue the policy objectives of retaining public confidence in federal share insurance, preventing impairment of the 1% contributed capital deposit, and ensuring that the Share Insurance Fund can withstand a moderate recession without the equity ratio declining below 1.2% over a 5-year period. Given my experiences just over a decade ago, I would have preferred that we prepare for a severe recession, but I recognize that the consensus on the board lies elsewhere. What is more, the updated policy and resulting normal operating level for 2022 provides a measure of additional protection against the unknown as we navigate through the next phase of the pandemic. So I will support the policy before us today. Finally, while the Share Insurance Fund continued to show solid performance throughout 2021, the equity ratio is projected to rise only to 1.28% at the end of the year. That is still below the new proposed normal operating level of 1.33%. As a result, credit unions should not expect a distribution from the Share Insurance Fund in the near term. Additionally, the stresses on the equity ratio from continued share growth, the low interest rate environment, at least historically, and insurance losses remain constant. So the NCUA board will need to analyze the fund's risk exposure and remain prepared to act to ensure the continued stability of the fund in the years ahead. As I have said before, the millions of members who use the credit union system to meet their financial needs are counting on us to get this right, and we need to do just that. That concludes my remarks. I now recognize Vice Chairman Hauptman.
Thank you, Mr. Chairman. And I want to thank the staff for that presentation. This is probably the most important topic that we deal with at this agency. Just to review a couple of basic facts, the Credit Union Act says the normal operating level can be set between 1.2 and 1.5%. If the equity ratio lands between 1.2 and 1.3, we, the board, have the discretion to assess a premium to bring it back up to 1.3. The premium we can assess is limited to bringing it up to 1.3 and no higher. And of course, a distribution to credit unions is required when the fund exceeds the operating level. Today, it's at 1.38, and today's recommendation is to drop it down to 1.33. I say all this because of a significant concern I've heard from the industry regarding a potential share insurance premium. I understand that concern, and earlier this year, we made the judgment call to have patience and caution. And as we anticipated, a number of metrics improved over the last 12 months. Credit unions were right. The dip in the the dip in the equity ratio was partially an artificial dip due to COVID-related stimulus efforts. So given the uncertainty of the past year, I think it was prudent to seek comment from the public on NOL policy. I, along with my fellow board members, encourage stakeholders to submit input and include any other relevant issues they believe the board should consider. I appreciate the work the staff did to evaluate the NOL. We must continue to improve our assessment of the appropriate NOL quantitatively using a standardized approach of relevant data and qualitatively based on experience and judgment. The NOL should obviously not be set arbitrarily, but rather set carefully considered with relevant and accurate data. The money in the SIF belongs to the credit union, every dollar of it. A higher NOL results in NCUA keeping more money than may be necessary, and that means less money for credit unions and their members. Since money at credit unions normally earns a higher return than the Treasury bonds and the Share Insurance Fund, that means every dollar in the SIF means the credit union system as a whole gets poorer. We have to balance that fact against NCUA's responsibilities as an insurer. I should note that one nice thing about low-earning treasuries is that they tend to rise in value in times of economic distress. That's a nice feature if you are an insurer. And finally, regardless of whether someone likes the fact that we are lowering the NOL today from 138 to 133, I think we can agree for right now it doesn't matter that much as a practical matter. We're projecting we're going to rise to 1.28 at the end of the year. And if we get to a situation where we're between 1.33 and 138. That's kind of a high-class problem, because right now we're not projecting it to get to that high anytime soon. So at least whatever disagreements we have right now, as a practical matter, they don't appear to have any real effect anytime soon. We don't earn a lot of money in the SIF, so it's not like we're adding tons of earnings every month. Mr. Chairman, that concludes my remarks, but I do have a couple questions. Number one is, some longtime professionals in the credit union system say, based on past performance, 1.30 is where we should set the NOL. It's hard to argue that 1.30 wouldn't serve us well in the past. How do we reconcile the past performance of the Share Insurance Fund being sufficient at 1.3 with setting it at any number higher than that, like we are today?
This is David Blanchard. The normal operating level is not a short-term measure. It is an estimate of what the equity level of the Share Insurance Fund should be over a 5-year time period to meet the board's policy objectives. Losses and economic events that cause them are unpredictable. By taking the longer view, the normal operating level is designed to estimate what the equity ratio should be to prevent it from falling below 1.20% during a moderate recession, which will avoid triggering a premium or a fund restoration plan. It is important NCUA maintain a strong share insurance fund for the mutual benefit of the credit union community and the taxpayers. It is also important for the NCUA to keep money at work at the credit union community in order to avoid or minimize any insurance fund premiums, especially the assessment of premiums during the times of economic stress. Specific to setting the normal operating level at 1.30%, it is important to note without the creation of the temporary corporate credit union stabilization fund in 2009, the normal operating level of 1.30 was insufficient to prevent the equity ratio from falling below 1.20% or even falling below the 1.00% capitalization level. Even with the creation of the stabilization fund, premiums of 8.9 and 10.3 basis points were necessary in 2009 and 2010 respectively to prevent the Share Insurance Fund equity ratio from falling below 1.20%. It is also important to note the actual equity ratio prior to the merger of the temporary corporate credit union stabilization fund and the Share Insurance Fund was only 1.25%. It was only after the two funds were combined that the equity ratio increased to 1.46% as of December 31st, 2017. After distribution from the combined fund brought the equity ratio down to the normal operating level of 1.39%, the actual equity ratio has slowly declined, hitting a low mark of 1.22% at June 30th, 2020. Had the normal operating level been set at 1.30% in 2018, there would have been another distribution of 9 basis points. Without that additional 9 basis points, the actual equity ratio would have fallen below 1.20% in June 2020, requiring a fund restoration plan and possible premiums, putting the equity of the Share Insurance Fund just 11 basis points from impairing the capitalization deposit. That concludes my answer.
Thank you, sir. Very thoughtful answer. And let me just throw one more at you, which is, I understand when we set this NOL, we employ a hypothetical moderate recession. Can you give us a sense of what that means in real numbers, like job loss, unemployment, that sort of thing?
So this is Andy Levinas, Chief Economist. I'll take that one. So when we take the midpoint of the Fed's baseline and severely adverse scenarios to form this moderate recession, we find that the unemployment rate peaks out at just under 7%. As you may recall, that rate broadly resembles unemployment rates that have been observed in various previous U.S. recessions. Obviously, there are other macroeconomic measures I could cite, but just to name one other, the imputed 7-year Treasury rate during this moderate recession falls to around 80 to 90 basis points. Obviously, that's a low rate, but a severe recession could certainly push interest rates lower than that. That concludes my response.
Gotcha. I might as well ask, last year we technically had a recession. It was more job loss than anything that's ever happened in American history, but it was very short. It was a very strange one, right? We lost 22 million jobs in 1 month. What would you refer to that recession last year that we had as? It was short, unbelievably deep and sharp, but it was also short.
Yeah, I think this is Andy Levinas. I think that's an unprecedented short and sharp recession would be a decent way of describing it. I mean, you know, there's no sort of typical recession. I mean, they're all a little bit distinct in their own ways. But you know, the type of recession that's contemplated in this scenario, you know, lasts a lot longer, is much more benign in terms of unemployment rates. Just for context, the 2001 recession in the United States put unemployment rates between 6 and 6.3%. The early 90s unemployment rate was, you know, 6.7 to 7.8%. And the 1980 recession put the unemployment rate around 7.8%. So we've had various flavors of kind of moderate recessions in the past, and they're much longer than, of course, the downturn that we had last year. But the downturn last year was extraordinary in terms of the unemployment rate and frankly, the severity. And of course, the federal response is always unique during downturns. And last year's federal response entailed a tremendous amount of stimulus and support for struggling borrowers and struggling consumers. That concludes my response.
Thank you, sir. Yeah, and like I said, one nice thing as an insurer is since we just own treasuries, in theory, the more vicious the recession, the higher treasuries should go. Right, their yields should drop even further, and that's good if you're long treasury. So that's, I guess, one buffer we have. That concludes my remarks. Back to the chairman.
Thank you so much, Vice Chairman. Let's turn now to Board Member Hood.
Thank you, Mr. Chairman. And David and Russell, I want to thank you as well for your presentations this morning. And also Vicki, Andy, and Myra, I want to thank you all for not only joining us today, but for your briefing earlier this week. Earlier this year, because of the pandemic, among other factors, I called on setting the NOL at 1.30, at least temporarily. When I called on lowering the NOL, I did so because it became clear to me that the NOL was too high because the taxi medallion crisis is behind us and any risk from the closure of the temporary corporate stabilization fund have generally ceased. I'm going to begin by asking one quick question, and then I have a few others to follow. But from 1984 to 2017, what was the normal operating level set by the NCUA board?
This is Russell Moore. From 1984 through 1987, the Federal Credit Union Act defined the normal operating level as an amount equal to 1.3% of the aggregate amount of insured shares in all insured credit unions, or such lower amount as the board may determine. The definition of the normal operating level was amended in 1998 to be an equity ratio specified by the board, which shall not be less than 1.2% and not more than 1.5%. So from 1984 through 2017, the normal operating level was set at 1.3%. With the merger of the temporary corporate credit union stabilization fund into the share insurance fund in 2017, the policy for setting the operating level was changed to be methodologically driven and ensure the fund can withstand a moderate recession, including the additional risk from the corporate credit union asset management estates. Under the new policy, the normal operating level was set at 1.39% for 2018, 1.38% for 2019, 1.38% for 2020, and left unchanged at 1.38% for 2021. That concludes my response.
Great. I want to thank you for that really detailed response. But just to go back, yes, it was at 1.30% for that time period. And it stayed at 1.30% during times of conflict and times of relative calm through economic booms and busts and through societal and technological changes. It stayed that way clearly, as you've mentioned, to 2017. when I believe the agency was really worried about the failure of credit unions heavily concentrated in taxi medallion loans, and quite rightfully so. I'll also note that when the NOL increase was done in 2017, it is indicated in the increase, and I quote from the remarks that I've read, it was intended to be temporary. As we approach 2022, and now that we have a few years of historical data to review the 2017 policy, I believe it's appropriate to take a look at the facts. This is an issue where I have seriously studied over the last several months, so my views have, quite frankly, they've evolved. Here's my thinking. If 1.30 is not adequate, I think the burden of proof then should be on the NCUA to show that this figure is inadequate. In that regard, I have a few more questions. Would a normal operating level of 1.30% cover every yearly loss the fund has experienced this century, including the taxi medallion losses?
This is Russell Moore. Without the creation of the temporary corporate credit union stabilization fund in 2009, a normal operating level of 1.3 would not have been sufficient to prevent the equity ratio from falling below 1.2% or even falling below the 1% capitalization level. If we knew in 2009 and 2010 what we know today about the net losses for the corporate credit unions, it is possible 1.3 may have been enough, but we don't know. Unfortunately, we don't have the ability to include unknown variables such as an extraordinary gains and legal recoveries that occur after the fact and loss estimates impacting the ratio. Without the merger of the temporary corporate credit union stabilization fund into the share insurance fund in 2017, premiums would have been necessary given the level of losses from the taxi medallion credit unions. That concludes my response.
Great, thank you, Russell. But even in the Great Recession, then, what were the actual losses in terms of basis points to the SIF, Share Insurance Fund?
Yes, sir. When measuring losses against insured shares, the natural person credit union losses were 4.4 basis points in 2008, 9.6 basis points in 2009, and 3.4 basis points in 2010. Keeping in mind the size of the share insurance fund was much smaller in dollars back then. That concludes my response.
Great, and now I want to pose what I realize is a hypothetical question. But for every basis point increase in the NOL, how much does that have the potential to take away from credit unions and ultimately their member owners in the form of a potential dividend based on this current point in time, assuming we are in fact required to pay a dividend?
This is Russell Moore again. Given the current size of the fund, 1 basis point equates to approximately $160 million. The only time credit unions would receive an NCUSIF distribution is when the actual equity ratio exceeds the normal operating level. Also, under the Act, the NCUA can only charge a premium when it would not result in the equity ratio exceeding 1.3%. So setting the NOL by itself does not necessarily result in credit unions having to provide the NCUA more money via premiums or result in less of a distribution when the equity ratio is below the NOL and not expected to increase above it. And the agency needs to strive to maintain a healthy and sound insurance fund that can withstand a range of economic conditions and loss levels, but not an inordinately high level that unduly impacts credit unions. That concludes my response.
Great, thank you. And again, for a very detailed response. Whenever we have these conversations at the board level regarding the NOL, I certainly believe it's always worth noting that our system is certainly different from the FDIC's, and quite frankly, as it should be. The risk profile is different between credit unions and banks, and while we have a corporate system, it should be noted that our system was built by design to incorporate both the NOL and the National Credit Union Share Insurance Fund, again, for the health and vitality of our cooperative system. Credit unions are legally committed and bound to update a large majority of the NCUSIF equity contribution. Credit unions today provide the bulk of the capital contributions that are the basis for the fund soundness, as we've now discussed, well over $21 billion. It's the cooperative insurance system prudently run by the NCUA. A premium is always an option under the law, but it can only raise funds to our normal operating level of 1.30%. Having an NOL above 1.30 negates a lot of the benefit that credit unions may receive by perpetually underwriting the 1% capital commitment to the National Credit Union Share Insurance Fund. The Vice Chairman often talks about incentives. As he puts it, you get what you incentivize. So moving forward, I would like to see if we can better incentivize the loss reserves of actual losses incurred. And this is relevant because the more we hold in loss reserves, the lower the equity ratio. The calculation before the board today sets the NOL at 1.33. What is the basis for the 1.33 calculation? Could you please explain in detail the way we got here, including any assumptions or calculations used? I think it's very important for the public to understand.
So this is Andy Levinas, the chief economist, so I'll answer that question. So the 1.33% is the result of calculation under the proposed policy. So essentially, it's a moderate recession to model the performance of the SIF over a 5-year horizon. Specifically, we take call report data and economic projections of credit union performance, analyze those during the recession scenario, and recall that recession scenarios developed as the midpoint of the Fed's baseline and severely adverse scenarios. So we analyze these outcomes, the critical outcomes of credit unions, I should say, during this moderate recession, and we're looking at insurance losses, insured share growth, and yield on investments during that 5-year period, and effectively the decline in the equity ratio during the 5-year scenario is used to derive our proposed normal operating level. As I indicated before, the moderate recession that we look at entails this year anyway, an unemployment rate of around 7%. That's relatively modest in historical terms, and the Treasury rates, as you might expect, drop pretty significantly during the hypothetical moderate recession, and insured losses grow. So that concludes my general response. Thanks for the question.
Yeah, Andy, thank you for the detailed response, but I maybe want to follow up with 2 maybe quick questions for you. What's the assumed loss rate in the calculation of the forecast, and what interest rates were assumed?
So the losses in the hypothetical scenario, the first year losses were around $200 million, $216 million. The second year losses were around $268 million. In terms of interest rates, we see in the scenario, we see the 3-month Treasury drop to between 10 and 30 basis points in the first couple years, and the 7-year Treasury, which is imputed, is between about 0.9 and 1.1%. I should say another key driver of the result, of course, is insured share growth. And during the stress scenario, insured share growth sort of is in the 5 to 7% annual range. That's actually not particularly, even though that's the result of the model, that's not particularly stressful. If you look at the 2016, 2017, 2018, and 2019 insured share growth during, of course, not particularly stressful periods, insured share growth during those non-stressful periods were in the 5 to 7% range. So ultimately, these key drivers drive the equity ratio decline during the 5-year period, and those were, as we indicated, the decline is 13 basis points. So we add that to 1.2%, and we get to the normal operating level of 1.33%. That concludes my response.
Great. Thank you, Andy. And I can just say, well, I believe you can easily make the case to have the NOL set at 1.30. Since today's proposal reduces the NOL to 1.33, it's something I can support since it removes things from the NOL calculation that are no longer relevant, and that is the risk posed by the closing of the temporary corporate stabilization fund, for example. In closing, will we commit to making a detailed calculation of the assumptions used to calculate an NOL public every year? That way, credit unions do not feel like this calculation is done without transparency. So I have no further questions. Thank you.
Thank you, Board Member Hood, and certainly we should have transparency around this calculation. Vice Chairman Haltman, is there a motion?
Yes, Chairman, there is. I move that the board set the normal operating level at 1.33% and adopt the policy for setting the normal operating level as attached to the board action memorandum.
Thank you. Is there a second to the motion?
I second.
There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and let the record show the motion passes 3-0. That concludes our discussion of the Share Insurance Fund 2022 normal operating level. The second item on our agenda today is Final Rule, Part 702 and 703, Complex Credit Union Leverage Ratio. Staff presenting are Tom Fay, Director, Division of Capital Markets, Office of Examination and Insurance, and Rachel Ackman, Senior Staff Attorney, Office of General Counsel. Staff available for questions include Myra Tepe, Director, Office of Examination and Insurance, Vicki Narwhal, Associate Director, Office of Examination and Insurance, Rick Mayfield, Senior Capital Markets Specialist, Office of Examination and Insurance, Catherine Metzger, Risk Officer, Office of Examination and Insurance, and finally, Ian Morena, Associate General Counsel, Office of General Counsel. Tom and Rachel, you may start at any time.
Good morning, Chairman Hopper, Vice Chairman Hopman, and Board Member Hood. I am co-presenting today with Rachel Ackman, Senior Staff Attorney, Office of General Counsel. Today we are here to present for the Board's approval a final rule on the Complex Credit Union Leverage Ratio, or otherwise known as CULR, and amendments to 2015 Risk-Based Capital Rule. First, the CULR provides a simplified measure of capital adequacy for federally insured natural person credit unions classified as complex. Second, this final rule was modeled on the Community Bank Leverage Ratio, or CBLR, established by the federal banking agencies. Third, under the final rule, a complex credit union that maintains a minimum net worth ratio and meets the other qualifying criteria will be eligible to opt into the CULR framework. A complex credit union that opts into the CULR framework is not required to calculate a risk-based capital ratio. A qualifying union that opts into the CULR framework and maintains the minimum net worth ratio is considered well capitalized. Fourth, when the NCUA board delayed the effective date of the RBC at its December 2019 meeting to January 1st, 2022, it concluded that the extension would provide the necessary time to do, one, holistically and comprehensively evaluate credit union capital standards. Two, determine how asset securitization would be considered for regulatory capital. Three, finalize the subordinated debt rule. Four, consider the other banking agency's CBLR model and how it would integrate into our capital standards. Five, determine how CECL and its methodology would integrate into NCUA capital standards. And lastly, provide additional time and resources toward the modernization of examination systems. Staff had considered each of these items over the past 2 years for this final rule. And lastly, the second objective of this final rule is to make amendments to the October 2015 risk-based capital rule. I will cover those changes and the final CCULR and RBC frameworks. But first, let me turn it over to Rachel, who will discuss the comments we received on the July 2021 proposal.
Thanks, Tom. Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. As Tom said, at its July 22nd meeting, the board issued a notice of proposed rulemaking to solicit comments on its proposed CULR framework and changes to the 2015 risk-based capital final rule. In general, many of the commenters supported the goal of providing a simplified alternative measure of adequacy for certain highly capitalized complex credit unions. However, most commenters expressed some concerns about specific aspects of the proposal. Specifically, almost all commenters recommended setting the cooler at 9% instead of 10%. Commenters generally discussed that a 9% ratio would be more consistent with the CBLR and would provide greater burden relief to complex credit unions without sacrificing safety and soundness. Other commenters suggested specific changes to the cooler framework, including changes related to goodwill and other intangible assets, reporting requirements when opting out of the cooler framework, and using net worth as the measure of capital. With respect to using net worth as the measure of capital, several commenters recommended creating a new definition of capital that included subordinated debt for non-low-income designated credit unions. Several commenters also recommended changes related to the 2015 risk-based capital final rule. For example, commenters discussed the proposed MSA deduction, treatment of securitization, and the treatment of goodwill and other intangible assets. Regarding goodwill, commenters raised concerns about the deduction of goodwill and other intangible assets related to supervisory mergers under the 2015 final rule. Finally, several commenters recommended that the board delay implementation of the risk-based capital final rule in the cooler framework. These commenters were concerned about the January 1st, 2022 effective date of both the risk-based capital rule and the cooler framework. I will now hand it back over to Tom to discuss changes in the final cooler and RBC framework.
Thanks, Rachel. So for cooler, I'll refer to the 8 major components of this capital framework and the changes we're proposing for this final rule. Number 1, first, the scope and opportunity to opt into the cooler framework is available when meeting the eligibility requirements to all complex credit unions. We propose to finalize this as proposed with no changes. Number 2, second, and the first modification to the July proposal is the cooler ratio. The cooler ratio will be set at 9% or greater with no transition period. This is a change from the proposal where a ratio of 10% was proposed, with an initial rate of 9% and a 2-year transition. Number 3, the eligibility items for the final rule are as proposed with no changes to the off-balance sheet exposures at 25% of total assets and assets and liabilities at 5% of total assets. Number 4, and the second modification for this final rule, is the eligibility requirement for goodwill and all assets, which was proposed at 2%. This final rule now excludes grandfathered supervisory goodwill from that 2% calculation, which is now consistent with the RBC rule. Number 5, opting into the cooler is finalized as proposed with no changes. Number 6, and the third modification for this final rule, removes the notification requirements for exiting the cooler framework. Number 7, and the fourth and final modification to the cooler proposal include providing a grace period for complex credit unions who opted into the cooler but fall out of compliance due to a supervisory merger. They will be provided with a 2-quarter grace period. And lastly, the reservation authority provision is being finalized as proposed. In summary, the cooler framework is 1, an option for credit unions that meet the eligibility requirements. 2, the cooler threshold ratio is set at 9% or greater with no transition. 3, the complex credit unions can opt in or out of the cooler framework at any quarter. And 4, complex credit unions who fail to meet the eligibility requirements after opting into the cooler framework will have a 2-quarter grace period to meet the requirements. A special note that most, if not all, of the components of the cooler are similar to the Federal Banking Agency's CBLR. Slide 6. This final rule also includes amendments to the 2015 RBC rule. I will cover those major items now. First, The final rule amends the RBC numerator and deducts the balance of mortgage servicing assets that exceed 25% of the RBC numerator from that numerator calculation. This change is consistent with the other banking agency's RBC rule. This change is being made to address any potential excessive MSA exposures at a complex credit union. Number two, and second, for asset securitization, this final rule is proposed with no changes in addressing risk weights for asset securitization issued by complex credit unions. Number three is also being finalized and assigns a risk weight of 0% to those loans consistent with the requirement of the CARES Act for paycheck protection loans. Number four, similar, the final rule is being proposed with no changes for risk weights for supranational organizations and multilateral development banks. The current rule does not have a specific risk weight for these investments, and therefore they would default to 100%. This final rule assigns a 0% for these investments consistent with the other banking agencies. Number five, the fifth item is also finalized as proposed in clarifying the exposure amounts, credit conversion factors, and risk weights for other off-balance sheet exposures. This change will make NCUA's RBC rule more comparable to the other banking agencies and more importantly, provide a significant burden reduction for complex credit unions calculating risk-based capital. And lastly, the sixth item, where we propose a change for the final rule to remove the December 2029 expiration date for the exclusion of goodwill. Any goodwill originating from a supervisory merger or combination that was completed on or before December 2015 will have no expiration date for exclusion to the RBC numerator. With this final rule, the regulatory capital framework for federally insured credit unions, with exception to new credit unions, will be as follows. First, credit unions who are not complex, that is credit unions with total assets less than $500 million, will only be subject to a net worth ratio for PCA. Second, complex credit unions, if not eligible or choose not to opt into the COOLA framework, will be subject to both the net worth ratio and the RBC requirements. As previously mentioned, if a complex credit union meets the eligibility requirements and opts into the COOLA framework with a ratio of 9% or greater, then they would not need to calculate a risk-based capital ratio under the final October 2015 rule. Before I finish, I would like to point out that we did include illustrations of the COOLA and the RBC call report forms in the July proposal. Highlighted here is the form to be used for the COOLA form. We plan on auto-populating as much data into the RBC and COOLA forms when possible to relieve burden on complex credit unions for 2022. We also plan on providing detailed instructions for credit unions to report on either the COOLA or RBC forms. And lastly, in my remarks, given the complexity of both the risk-based capital, the COOLA, and the related call report forms and instructions, we plan on hosting industry webinars to provide credit unions with the opportunity to ask or submit questions on the forms and instructions during Q1 2022. In addition to that, for staff and examiners, we plan on coordinating training during several times during Q1 22 as well, including sessions on capital, subordinated debt, and the overall call report changes for March 2022. Thank you, and this concludes our prepared remarks. We will be happy to answer any questions.
Thank you, Tom and Rachel, for your informative presentation and your diligent efforts in bringing before the NCUA board today the Complex Credit Union Leverage Ratio Final Rule, also known as COOLA, and amendments to the agency's 2015 Risk-Based Capital Rule. I also appreciate that Myra, Vicki, Rick, Catherine, and Ian are available for questions, although I have none today. I have long held that all financial institutions backed by federal deposit insurance, including federally insured credit unions, should hold capital equal to the risks held on their balance sheets. In the case of federally insured credit unions, if a credit union with greater risks fails, risk-based capital would help absorb and minimize losses to the National Credit Union Share Insurance Fund. Capital, after all, is the first line of defense against losses. In the event of a complex credit union's failure, the additional capital buffer provided through a robust risk-based capital framework protects surviving credit unions, their members, and the taxpayers who ultimately guarantee the Share Insurance Fund. When it comes to risk-based capital standards for credit unions, we have several legal responsibilities, which can be summed up in 4 words: comparable, consistent, complex, and cooperative. First, these standards need to be comparable to the rules developed by other federal banking agencies. Second, our rules must be consistent with the requirements of the Federal Credit Union Act. Third, whereas risk-based capital rules apply to all banks regardless of size, our rules need only to apply to complex credit unions, which the board has currently set at $500 million or more in assets. And fourth, our risk-based capital rules must address the cooperative nature of the institutions the NCUA oversees and insures. In my view, the risk-based capital rule approved in 2015 met all of those standards. And when finally implemented at the start of 2022, it will provide the system with greater stability. We must, however, also recognize several legislative, regulatory, and marketplace developments since the NCUA board approved the final risk-based capital rule in 2015. For example, in 2018, Section 2001 of the Economic Growth, Regulatory Relief, and Consumer Protection Act directed the other federal banking agencies to propose a simplified alternative measure of capital adequacy for certain federally insured banks. The result of that effort became known as the Community Bank Leverage Ratio Framework, which became effective in January 2020. Since 2015, the NCUA has also approved several regulatory measures, like our new final rules on subordinated debt and derivatives, which affect a credit union's capital levels. Additionally, credit unions have begun issuing their own loan securitizations to investors. In acting today, we should take these developments into consideration. Accordingly, the final rule incorporates all of these items and addresses stakeholder comments gained as part of an earlier advance notice of proposed rulemaking approved in January, as well as the proposed rule issued in July. Primarily, this final rule would amend the NCUA's capital adequacy regulation to provide a simplified measure of capital adequacy for federally insured credit unions classified as complex. The proposed complex credit union leverage ratio for federally insured credit unions is comparable to the community bank leverage ratio. In essence, both standards seek to strike a balance among several objectives, including maintaining strong capital levels, protecting safety and soundness, and simplifying compliance. So long as an eligible credit union in the Cooler framework maintains a minimum net worth ratio, it would be considered well capitalized. Our biggest decision in finalizing this rule was at what level to set the Cooler. In reaching a consensus, we looked at the lessons of a famous children's story. Some wanted the leverage ratio to be 8%. I viewed that as too soft. I wanted the final Cooler level to rise over time and reach 10%, a level that others considered too hard. So we compromised and have permanently set the Cooler at 9%. That ratio turned out to be just right. While lowering a credit union's risk-based capital compliance requirements, Cooler actually increases the system's capital buffer. If all 473 complex credit unions currently with a 9% net worth or higher opted into the Cooler and continued to hold the minimum 9% net worth ratio required to be well capitalized, the total minimum net worth required is estimated at $111.8 billion, an increased capital requirement of $24.3 billion over the minimum required under the 2015 final rule. This additional capital would strengthen the system's ability to absorb any future financial losses and economic shocks. The proposed rule makes several other changes to the NCUA's risk-based capital rule, including clarifying the treatment of off-balance sheet exposures and deducting certain mortgage servicing assets included in the complex credit union's risk-based capital numerator. The proposed rule also clarifies the risk weights for asset securitization, which were not included in the 2015 rule because credit unions had not yet engaged in that activity. While we have seen some positive signs in the economy and in credit union performance data, we are not out of the woods just yet when it comes to the COVID-19 pandemic's economic effects. With pandemic relief programs now expiring, many households could soon face financial stress. If so, then we could see even higher delinquency and charge-off rates and potential losses for credit unions, and even failures in the months ahead. An uncertain interest rate environment and the potential for continued elevated insured shares also place additional stress on credit union capital levels. As such, this proposal is an appropriate measure that provides complex credit unions with a streamlined approach to managing their capital levels while also strengthening the system's resiliency to economic shocks. In sum, this final rule is a balanced approach that gives complex credit unions a risk-based capital framework comparable to those developed by the other federal banking agencies. The final rule strengthens the system's capital levels and provides 70% of complex credit unions with a streamlined approach to managing their capital. As we continue to address the pandemic's fallout, this final rule is a prudent course of action. That concludes my remarks. I now recognize the Vice Chairman.
Thank you, Mr. Chairman. And thank you to Tom, Rachel, and the rest of the staff who worked on this rule. I think we all agree that more capital unto itself is a good thing. In my confirmation hearing, I called capital the holy grail, and I meant it. Capital levels must be appropriate, though. Excess capital in a credit union comes at the expense of services, dividends, and fees to the member owners. People whose hard-earned money already funds this agency and the insurance fund itself. As member owners, they are part of the credit union system. I'm mindful that our actions directly affect their access to financial services. And remember, we talk a lot about inclusion around here. Our first duty is the safety and soundness of the shared insurance fund. That has to be balanced with the needs of credit unions and the 128 million members. It's no secret I'm not a huge fan of risk-based capital, even though I'm obviously aware that some assets will be riskier than others. The issue with risk-based capital regime is the way it's derived. And here are the four issues. One is that it's a political process by definition. Political appointees from various countries advocate for whatever risk weightings most advantage that country's institutions. Secondly, risk weights that are appropriate for one institution may not be suitable for others. For example, the exact same asset may be riskier at institution A versus institution B, partly because of things like servicing that asset. Third, RBC forces capital decisions today based on risk weights that may not be appropriate in the future. And last, RBC often doesn't work, and it even produces the opposite effect that we want, such as in the European debt crisis, when banks were incentivized to hold the very bonds that were the kryptonite that caused the crisis in the first place. And banks were incentivized not to hold less risky assets that would have lessened the damage of the crisis. So having said all that, I'll confess that I don't have an easy solution to offer, except to say that some level of capital, computed in a simple manner, should be enough to allow a credit union to bypass the hazards that are inherent in risk-based capital. One of my first requests as board member was for the agency to do what our colleagues at FDIC did and create an alternative to RBC, an off-ramp, if you will. Today, we have before us the complex credit union leverage ratio, COOLR, which is intended to provide a meaningful RBC alternative for well-capitalized complex credit unions. I am sincerely grateful to our E&I and OGC members who contributed to this effort, including Tom Fay and the capital markets team, as this was a difficult process, and it's a process that I know I didn't make any easier. This final COOLR rule isn't exactly what I envisioned, but it does offer a choice. As of September 30 of this year, 71% of credit unions subject to RBC have a net worth ratio greater than 9% and would be eligible to the COOLR framework, notwithstanding any other eligibility requirements. I share the concern of some that the creation of this new COOLR will ultimately force credit unions to hold more capital than needed. Although the definition of well-capitalized is 7%, that's in statute. The average credit union has a cushion of roughly 3% above that 7% level. As of the third quarter, the aggregate net worth of the credit union system came in over 10.2%. So I believe we'll see a similar scenario play out with Cooler. Although we're going to set it at 9% in practice, does that actually mean 11, 12, 13%? And although we got Cooler finished this year, we have a duty to understand the cost of implementing risk-based capital and Cooler against the benefits to the credit union system, not the benefits to us at NCUA, to the credit union system. The board intends to monitor the impact of Cooler and RBC on credit unions and the Share Insurance Fund going forward. I look forward to working with my board members next year and the year after on quantitative analysis on the costs and benefits of our current approach to RBC and Cooler. That concludes my remarks. I do have a few questions. One probably for Tom, but with this rule, how does Cooler differ from the bank CBLR?
Vice Chairman Hoffman, this is Rick Mayfield, and I'll be taking this question. There are two material differences between the Cooler and the bank CBLR. First, the CBLR is only available to banks under $10 billion in assets. The Cooler option is available to complex credit unions over $10 billion, provided they meet the other Cooler qualifying criteria. Secondly, the Cooler has a qualifying criteria that goodwill must be under 2% of assets. The goodwill qualifying criteria does not include excluded goodwill, which is also known as supervisory goodwill before December 2015. And lastly, a more technical difference between the CBLR and Cooler is that advanced approach banking organizations cannot use CBLR. NCUA's risk-based capital framework does not have a parallel to the advanced approach in risk-based capital, so Cooler does not have this criteria. This concludes my answer.
Gotcha. Can you tell me how has the treatment of goodwill changed in this rule today versus the proposed rule we had earlier?
So, Vice Chairman Huffman, I'll take that question again. There are two changes in treatment in goodwill in the final rule. First, excluded goodwill will not be included in the 2% goodwill qualifying criteria under the Cooler framework. Excluded goodwill, once again, is goodwill originating from a supervisory merger or combination that was completed before December 28, 2015. The proposed rule included excluded goodwill, that's a mouthful, in the 2% goodwill qualifying criteria, and the final rule does not. Secondly, the term excluded goodwill will no longer expire on January 1, 2029. By no longer expiring, complex credit unions will no longer be required to deduct excluded goodwill from the RBC numerator after January 1, 2029. This concludes my answer.
Thank you, sir. Can we look at the universe of the credit unions that are affected by RBC and Cooler? What portion of those credit unions will no longer use 7% as their most important capital standard?
Vice Chair, hi, it's Tom. I'll take that question. So let me just set this up first. So as we've been stating, effective for 2022, complex credit unions, those with assets over $500 million, or as you've indicated, subject to RBC and Cooler, will be subject to regulatory capital framework, including two things: a net worth ratio of 7% and an RBC ratio of 10% to be well capitalized. So let me respond to your question using a scenario. There may be situations where the complex credit RBC ratio falls below 10%, but the net worth remains above 7%. So therefore, the RBC ratio becomes what we call the binding constraint, thus requiring more capital to support the risk assets to maintain a well-capitalized PCA classification. Of course, the credit union can change their asset profile to get back in line with 10% as well, not just increase capital. So as a result, any increase in that capital essentially implies a higher net worth ratio because they've had to increase capital. So their parallel between the 7% and the 10% become a higher requirement. Just as a note, because you mentioned some statistics, as many as 73, so on to respond to your question, and let me talk about all complex, as many as 73 of the 680 credit unions that are complex, this is as of June, will have a higher capital requirement under RBC. And for an estimated almost $600 million. This doesn't mean that they need to go out and increase their current capital today, which may already exceed the well-capitalized requirement, but that their capital requirement, that's the key word, requirement, will be higher. This concludes my answer.
Okay. So is it fair to say that for the credit unions in question, the majority of them, 7%, will cease being their most important capital standard?
Well, in terms of requirements, I think the majority of complex credit unions will still be bound by 7% because their RBC requirements will not require them to hold more capital. So let me say it differently. 7% will still be a key threshold for complex credit unions to be well capitalized.
But it is true that a majority of complex credit unions are now, when they look at, am I well capitalized or not, the majority will no longer solely use 7% as their holy grail.
Well, obviously with this framework, they have to meet two ratios in order to be well capitalized. We have this framework today under RB&W. With RBC, though, however, it's more improved. And when they go calculate those two ratios, they will see in meeting those two that they will not have to increase capital because of RBC. Okay, so the lowest common denominator between the two will be the 7% net worth ratio.
Okay, and why will they not have to raise capital?
Well, because they would exceed the 10% RBC rate. In our estimate, anyway, they would exceed the 10% RBC ratio. Therefore, they wouldn't have to raise capital because they're already above 7% on the net worth.
Okay, that brings me to my last question here, which is, you say they don't need to. What we do know, Tom, is based on our latest data, credit unions currently average 10.2% net worth. So that's over a 3% buffer over the current 7% standard. Would it make sense to think that credit unions will continue to have a buffer of, call it 3%-ish? So when we say we're setting cooler at 9, somebody who's at 9.2 isn't necessarily going to feel they're in the clear because we already know they average about a 3% buffer above what is required. So does it stand to reason that when we have a cooler at 9, that they will continue to have a buffer kind of like that? So what we're really looking at is them raising capital to 11, 12, 13?
All right, Tom, let me respond to that. So credit unions manage their capital in very different ways, I would say. As we know, cooler is an option. It's not a requirement. So if a credit union makes the decision to hold capital above 7% or even above 9%, that's a business decision they make as long as it's within our PCA guidelines. If a credit union should decide to hold in excess of 9% capital, that's their decision. It is also an opportunity for them to relieve their RBC burden or regulatory capital requirements. Thank you.
Does it stand to reason that a, call it 3% buffer that we have now will continue in the future?
Again, I don't really know where the buffer. I mean, obviously, any buffer over a minimum capital requirement, serves to reduce the probability of failure, right, or a significant deleveraging in times of stress. It could, for most credit unions, a buffer could mean the difference between survival or failure, right? At the end of the day.
And we know that they keep a buffer of 3% right now, a little over 3%. Do you have any reason to believe they will not continue to keep a buffer of around 3% in the future?
I don't think I could estimate that, Vice Chair.
Okay. Well, we can agree they do now have a ratio. All I'm trying to say is when we say, oh, no, this isn't going to affect somebody because most of them, if you already have 9.5%, you're in the clear. But we already know that they like to have a buffer. So I think we just need to acknowledge that based on the way the credit unions operate, that being just above 9% does not mean you're in the clear to meet our 9% cooler, because we know that they want to have a buffer for the reasons you just eloquently said. So we shouldn't be doing this without acknowledging that we are making credit unions hold substantially more capital because they are going to have a buffer. You think it's good they have a buffer, so do I. We are raising capital standards for credit unions. I just think we need to be very clear about that. And we shouldn't be disingenuous to say, oh, no, look how many of them have over 9%. They should be fine with cooler. Well, we already know they have a buffer. So there's no reason to think the operations of credit unions will suddenly change. And we are raising capital for the vast majority of these because they will have that number of 10.2, at least for those subject to RBC and cooler. I'm happy to bet you cash that number will go up because of what we are doing today. That concludes my remarks. Back to the chairman.
I don't know that you want to bet cash. We may have to consult with our ethics, but I hear your point, Mr. Vice Chairman. Board Member Hood, please proceed.
Great. Thank you, Mr. Chairman. And Tom and Rachel, thank you for your presentation this morning. And as many of you know in the industry and even here at the agency, cooler is something I've long supported since coming here in April of 2019. So I'm delighted that we are here today discussing this important topic. Since the founding of the credit union movement in this nation nearly a century ago, I've been told that many credit unions, especially during the early part of the movement, as many of you know, were started with limited to very little capital at all. While the credit union system has certainly advanced since the founding of this movement up until today, it's important to keep in mind as we discuss risk-based capital and the complex credit union leverage ratio. The framing of the issue today is really about capital adequacy, and if credit unions have shown through history, they have sufficient capital to serve member owners while facing various risks. To that end, I do have a few quick questions to begin. Would RBC have changed the outcomes of the crisis with the corporate credit unions that we experienced a decade or so ago?
Board Member Hood, this is Rick Mayfield, and I'll be answering this question. The answer to this question is not simple, at least for the RBC construct that was in place during the crisis. Corporate credit unions didn't have RBC then, so my answer is going to assume that they were actually doing an equivalent to the bank RBC. So it may have changed the outcome to the corporate crisis had it been in place, but it would be highly dependent on where the RBC ratio for well-capitalized would have been set. So a 10% RBC ratio may have had some effect, but it is still very likely that corporate credit unions may have still purchased large amounts of highly leveraged subordinated tranches since the risk weightings at the time were ratings-based. Many highly leveraged subordinated tranches were rated AA or AAA before the corporate crisis, and they were risk-weighted at 100%. On the other hand, the RBC construct that will be effective January 2021 would have had a material effect on the corporate credit crisis had corporate credit unions been subject to the RBC requirement. Given the large concentrations of subordinated tranches, the conserved corporate credit unions would have been required to either hold more capital, and this would be likely multiples more, or had less exposure to subordinated tranches to be well capitalized. And that exposure might have actually been in the single-digit percentage of what they actually held. The increased or reduced exposure to subordinated tranches would have led to lower losses, and there would have been at least a fair chance that some, if not all, of the conserved corporate credit unions would not have failed. This concludes my answer.
Great. Thank you, Rick. And continuing along that path, I don't know if you can answer this question as well, but I want to shift from the corporate credit unions to something that's been a lot on our mind lately, and that is the taxi medallion losses. And I recognize that with the taxi medallion losses, those were primarily caused by concentration risk. And our National Credit Union Share Insurance Fund was able to absorb those losses. So to be clear, would RBC have changed the outcome during the taxi medallion crisis?
Hello, this is Catherine. I'd like to address this question if I may.
Of course, thank you.
The NCUSIF was positioned to absorb the losses incurred resulting from the credit union failures with a large concentration of the taxi medallion loan. The majority of the taxi medallion associated credit union failures resulted in a loss the NCUSIF occurred in 2018, with the losses totaling about $840 million. The NCUS fund balance at that point in time was $16.7 billion, thus sufficient to absorb those losses incurred. I hope that answers your question.
It certainly does, Catherine. Thank you so much. I will readily acknowledge the Federal Credit Union Act requires the NCUA to maintain a system of prompt corrective action for federally insured credit unions that is based upon an institution's level of capital, that is, its net worth. And as noted with the Vice Chairman's questioning, we are all delighted and pleased that today's aggregate rate ratio is 10.2%, some 300 basis points beyond the statutory requirement. Those levels are in fact set in the Act. The Act also requires us as a board to maintain a risk-based net worth requirement for those institutions that are deemed to be complex credit unions. And Tom, I know from our briefing earlier in the week, there are 684 of those institutions. We now have that with our risk-based net worth requirement. The law gives this board serious responsibilities, which we must faithfully uphold. But this does not mean that since the bank regulators established a risk-based capital regime, we must follow them. I actually worry that once we decree that 7% may no longer be adequately capitalized, then whether it's this board or a future board that settles on 8, 9, 10% net worth in the complex credit union leverage ratio, as some say in North Carolina, the barn door is now open to that interpretation or that change. I worry that we may have set an arbitrary standard above the law that a future board can easily change at any time. Before 1998, there were no legal standards for a net worth ratio to be well capitalized. In 1998, the law raised well capitalized to 7%. The law instructed us to set a risk-based net worth requirement based on the portfolios and liabilities of credit unions for any material risk where adequately capitalized may not provide adequate protection. While it could be improved, we have that standard today with our risk-based net worth. That standard will be replaced by the RBC rule. Lamentably, the RBC rule is very complex and burdensome, and that is why I was pleased that we do in fact have the COOLA rule, which will be an off-ramp to RBC as long as credit unions with $500 million or more in assets hold 9% or more in net worth and meet some of the other qualifying criteria. The RBC rule is so tragic that, yes, it needs an off-ramp. While you will have individual instances of issues around risk-based capital and credit unions' balance sheets, in my view, that is why you have examinations. We shouldn't dictate that 9% or higher net worth is needed for complex credit unions over $500 million if they choose to opt out of RBC with COOLA. One way to think of requiring credit unions to hold more capital than is required by law is to essentially consider it a regulatory tax. And whatever figure is set by RBC or COOLA, credit unions will generally want to have a cushion or buffer, as has already been discussed with our Vice Chairman. So really, it's going to be above that level set by risk-based capital or by COOLA today. Credit unions are far less risky than banks by their nature, and the more capital we put on the sideline, the less money credit unions can deploy for things I know that we want them to do, such as embracing fintech, embracing DEI, embracing any of the things that they need to do to better serve their member owners. The less assets they have to do that is because of some other cushion that they're now going to feel compelled to uphold. Yes, I would be derelict and feckless in my responsibilities if I did not support a risk-based net worth requirement for complex credit unions to take account of any material risk against which the net worth ratio required for an insured credit union to be adequately capitalized may not provide adequate protection. That indeed is what the law requires. But I do not agree with the premise that current capital regime we have today has proven inadequate, nor that we should throw out the current risk-based net worth regime for RBC. In 2019, as then chairman, I worked with the NCUA board to delay the risk-based capital rule for 2 years to holistically evaluate the NCUA's capital standards to ensure they would serve us well in the future. This also was an opportunity to further study the impact of the risk-based capital rule. During that time, staff said there were 3 main additional considerations that were warranted: subordinated debt, the complex credit union leverage ratio, which we're discussing today, which we're of course are now calling COOLR, and then also the other component was securitization. Where work remains to be done with securitization, we made profound progress in terms of the agency's view of capital compared to where we were in 2019. However, Mr. Chairman, my stance today remains the same as it did when the proposed rule was before the board. So I contend that after serious study and consideration, my preference is to consider repealing the RBC rule outright and fine-tuning our existing risk-based net worth rule. At this point, though, I do have a few remaining questions. How many credit unions over the last 5 years would be covered by today's RBC rule?
Mr. Hood, hi, it's Tom Fay again, and I'll respond to your question. But before I do, if you don't mind, I've had a chance to think about Vice Chair's question, and you have made the same reference to capital buffers. And I think it's important to acknowledge, because you asked me, Vice Chair, to acknowledge whether a buffer is something that will be maintained. I mean, the easy answer is yes. I mean, I should acknowledge that some buffer will be present, right, going forward. There's no doubt. We think credit unions are prudent and conservative in their risk management. And hopefully, their optimal level of capital is incumbent upon them and their senior management. So for instance, and for example, if they think a 10 to 11% capital range is what they would like to have, well, then the 9% is not much of an issue for them, right? And if COOLR is still an option, they can always control that level of capital or that buffer they wish to have over time. So anyway, I wanted to, we think to your point too, it remains to be seen. Will this change behavior? Will it not change behavior? Will they adopt both the RBC rule and the COOLR rule in stride over time? And so I look forward as well as you are to see how this all falls out in the industry. To your question now, and I'll restate it because I had to answer the other one. I think you asked how many credit unions over the last 5 years will be covered by the RBC rule. And so the answer to that, and I'll respond now, is first, the definition of complex has changed over that 5 years too. $100 million complex level in up to 2018, and then we moved that up to and then the board moved that up to 500 million. And so using that 500 million threshold, if you think about it, the number of complex credit unions over the past 5 years has increased dramatically at 37%. And we are now at 685, I think you mentioned, as of September. What's even more impressive and even more something we should acknowledge is the level of assets in those same institutions has increased by 76%. Complex credit unions today have total assets of almost $1.7 trillion. Okay, that is a significant portion of the industry when we think about almost 5,000 institutions in the industry today, but 685 of them have 1.7 trillion of the total system, which has now eclipsed $2 trillion, right, as of the latest September report. So anyway, as for COOLR, if we look back, notwithstanding the eligibility requirements and a trend of 9%, The total has decreased, however, to 71% more recently, only because we've seen significant decreases in the net worth ratio from growth in assets. Because we knew years ago that was close to 90% that would be able to opt in. Now it's only 71%. So that includes my answer.
Well, thank you, Tom. And continuing then, of those that you've mentioned, how many credit union failures were there in that same time frame?
Failures, I'm going to defer to my colleagues. Thank you.
Oh, thank you.
I apologize. This is Catherine. I would like to actually address that, if I may. So when we're talking about credit union failures, we can look at it two ways. If we're looking specifically at the credit union failures in the last 5 years that caused a loss to the fund with assets greater than $500 million, we experienced one credit union failure that meets that, all those categories. Overall, during the same period of time, however, we've experienced 38 credit union failures that caused a loss to the Share Insurance Fund in the last 5 years. However, like I said, only one of them had assets in excess of $500 million. That concludes my answer.
Great. Thank you, Catherine. And I don't know if this is going to remain with you for the follow-up or whomever is appropriate. And how much more protection would this have saved the Share Insurance Fund over the last 5 years?
That would be me as well. This is Catherine again. So let me take this two ways, if I may. If we're looking at just the credit unions with assets over $500 million, those deemed complex under the risk-based capital rule, and we compared what their minimum net worth would be at 7% compared to what the risk-based capital rule would have required, that 10% of risk-weighted assets, RBC would have required that institution, noted earlier, to hold $77 million more in capital as of their last call report filing. If we're looking at the industry as a whole and comparing our current net worth leverage ratio minimum capital requirements versus our risk-based capital rule, had it been in effect for complex credit unions, we would have seen in general credit unions being required to hold anywhere from $570 million to $820 million in additional capital overall. That's not just for the failed credit unions, but for the complex credit union industry during that 5-year period. I hope that answers your question.
It certainly does, Catherine, and thank you so much. As I said during the proposed rule, the reality is that RBC should be a tool and not a rule. And if it is effective in identifying risk, then it should be put in the examiner's toolbox. But the last thing I think the NCA should do is to impose it on credit unions as an operating model. The juice just isn't worth the squeeze for risk-based capital because this is a regulatory burden with, I believe, what's limited benefit. But I still must say, I think risk is something that you manage each and every day. It's not a formula that you can run on your balance sheet. Following up with a few questions, what have been the largest 5 losses to the Share Insurance Fund over the last 10 years, and what were those losses in, to be specific?
Hello, this is Catherine again. I will try to address your question. When reviewing credit union losses of natural person credit unions in the last, I actually looked back about 10 years, we can say, out of the last 10 years, 3 of the 5 largest losses were the result of concentration risk, frequently referred to as the taxi medallion crisis. The 3rd largest loss to the fund was a result of poor operating management, high concentration of real estate loans, also the rapid decline in real estate values following the Great Recession. And lastly, the 5th largest loss was of fraud, which is also an internal risk. As a risk-based capital framework is designed to require higher capital requirements commensurate with the risk of the balance sheet, it does not provide additional protection to the fund as it relates to fraud. Further, the risk-based capital framework would only apply to one of the failed institutions, as mentioned earlier, one credit union over $500 million. as the remaining 4 had assets less than the complexity threshold. Again, as you noted, there's multiple tools in our toolbox, so it's important to reiterate that the agency also has implemented additional items, including our concentration risk program, to address concerns, in addition to the risk-based capital as only one of our tools. That concludes my response.
Great, Catherine. Then just continuing on that path, then had the RBC rule been in effect, what the losses have been, and then if you can also incorporate, were those losses caused by internal or external events?
Let me take myself off of mute. I apologize there. You always have to remember that mute button. Again, this is Catherine. And now I've lost my train of thought. I apologize. Could you repeat the question?
Oh, yes. Just continuing with the 5 losses to the Share Insurance Fund over the last 10 years, and you had given me a very detailed response. I wanted to know, had the RBC rule been in effect, what would the losses have been then? And were those specific events of those losses caused by internal or external matters or factors?
But those losses were, in fact, caused by internal factors. And I apologize. I'm going to have to get back to you to have the specific dollar amounts of the losses for those individual institutions.
Very well. Well, thank you, Catherine. And then I'm going to continue on to our next question. How do we go about explaining the fact that many credit unions, all of whom exceed the 7% well-capitalized level, and many of them even have higher levels when they seem to be losing members and loans, and yet they can still meet our criteria for safe and sound? I guess the question is, what is missing in the RBC model for these credit unions for managing this risk?
Board Member Hood, this is Rick Mayfield, and I'll be answering this question. A credit union's capital level is one of several factors considered when evaluating safety and soundness of a credit union. Where a credit union is losing members and loans is almost exclusively concentrated in non-complex credit unions. In these cases, losing members and loans may not result in negative earnings and would oftentimes result in a credit union still being safe and sound. In cases where the credit union is losing money, the level of net worth and the prospects for future earnings would factor into whether the credit union is safe and sound. As for what's missing in RBC for these credit unions for internal risk, the short answer is nothing. RBC is a measure of capital over risk-weighted assets. The type of internal risk mentioned in this question is addressed in supervision. This concludes my answer.
Great, thank you, Rick. And then maybe this can be the last question for you. Can we assume then that RBC would prevent a future credit union failure?
If Rick doesn't mind, Mr. Hood, I'll take that question. This is Tom.
Very well. Thank you, Tom.
Yeah, I think the best way to answer this is when you think about RBC, I mean, no single risk measure in general will ever prevent losses or from a credit union to fail, and that includes RBC. You know, the risk-based capital standards are not a panacea for safety and soundness, right? The risk-based capital is designed to address a range of credit risk and concentration outcomes, but not prevent credit-related financial institutions' failures. Flaws could be by severe economic scenarios. Capital standards are intended to work in tandem with other risk mitigation requirements, including interest rate risk, liquidity, credit, governance, and risk management over their operations for safety and soundness in general. That is why we evaluate for these other factors during examinations. A strong examination and supervision program that assess all of these risks, including capital, can be the most effective way to prevent a credit union failure. That concludes my answer.
Great, thank you, Tom. And I'm just going to wrap up here. While RBC may require higher net worth ratios at complex credit unions over $500 million based on how we risk weigh their activities, we simply cannot assume that RBC would prevent a credit union failure, and we cannot assume that since risk itself evolves, that the risk weights are fixed and are set for all of the time. If anything, I think that RBC creates a moral hazard because we, as regulators, are weighting risk. We're simply given a stamp of approval on the weights of risk, but we should recognize that since risk evolves, it's simply not stagnant. Risk will never be captured by formulas to manage a balance sheet. In closing, while I do not support the risk-based capital rule at this time, I'm also mindful that it is December 2021, and this date is relevant because the RBC rule goes into effect in January 2022 as it stands now. The final rule today does provide an off-ramp to RBC with the credit union leverage ratio, cooler, which is indeed a small step, I think, in the right direction. Credit unions that are subject to RBC will be required to have a 10% RBC ratio to be well capitalized. The rule before us today allows credit unions who are eligible to opt into the cooler framework with a 9% net worth ratio and would not be required to calculate RBC ratios. Cooler is a simple ratio that doesn't have all the burdens and calculations required under RBC. While I would have preferred the cooler to be set at 8% for the net worth requirement, especially when considering the cooler analog for banks was 8% in 2020, 8.5% this year before finalizing their transition back to a 9% threshold in 2022. Setting cooler at 8% is just as arbitrary as setting it at 9%. However, the 9% net worth requirement that remains for cooler is better than the 10% net worth requirement under the proposal, and I'm glad that the three board officers can get together to address this issue. So, because of the aforementioned factors, Mr. Chairman, I will reluctantly vote for today's proposal. I think this board, however, must monitor the outcome to see if this rule is really needed in the months and years ahead. Thank you. That concludes my questions and comments on this matter.
Board Member Hood, thank you so much for your remarks and questions. Is there a motion?
Yes, Mr. Chairman. I move that the board approve final. Oh,
I coughed. I'm sorry. I coughed. I'm sorry.
I thought it was the speech. I was blessing you. I don't know if I redact a bless you for a cough, but anyway, I move that the board approve final rule parts 702 and 703 of the NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion?
I second the motion.
There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and let the record show that the motion passed 3-0. The third item on our agenda today is Final Rule, Part 703, Mortgage Servicing Assets. Staff presenting, John Nilles, Senior Capital Market Specialist, Office of Examination and Insurance. Tom Fay, Director, Division of Capital Markets, Office of Examination and Insurance. And Ian Morena, Associate General Counsel, Office of General Counsel. John, Tom, and Ian, you are now recognized.
Good morning again. It's Tom Fay, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. I will be joined by Office of General Counsel and John Nilles, Office of Examination and Insurance. We are here to present a final rule that would allow federal credit unions to purchase servicing assets from other federally insured credit unions as permissible investments under Part 703 of NCUA rules. MSAs result from contracts to service loans that are owned by others and secured by real estate, for which the benefits of servicing are expected to more than adequately compensate the servicer for performing that function. MSAs are maintained in accordance with GAAP, generally accepted accounting rules, and servicing activities include collecting payments from borrowers, remitting those payments to investors, managing delinquencies, and handling foreclosures. NCUA's investment rule has prohibited credit unions from purchasing MSAs since 1997, and the board has retained this regulatory prohibition over the years due to safety and soundness concerns. At its December 2020 meeting, this board issued a notice of proposed rulemaking proposing to amend the agency's investment regulation. The NPR provided a 30-day comment which closed on February 1st of 2021. John Nilles will discuss the changes being made for this final rule, but before that, Ian Morena will summarize the stakeholder comments the board received on the NPR. I will now turn it over to Associate General Counsel Ian Moreno.
Thank you, Tom. This is Ian Moreno in the Office of General Counsel. The agency received a total of 11 comments on the proposed rule from 2 natural person federal credit unions, 8 credit union leagues or trade associations, and 1 individual. All but one of the commenters supported the removal of the regulatorily imposed prohibition in the investment rule that currently prevents federal credit unions from purchasing MSAs. Several commenters stated that additional conditions should be considered or included in the final rule. 2 commenters, however, urged against conditions that would limit the investment authority, suggesting that credit unions should be solely responsible for managing their risk mitigation. They also asked that the rule be more expansive to include purchases of MSAs from parties other than federally insured credit unions. As noted, one commenter opposed the rulemaking, expressing concern that credit unions and supervisory staff may lack sufficient understanding or expertise in deriving the underlying value of MSAs. This commenter concluded, however, that some of the concerns may be mitigated if a credit union applies a prudent retention strategy backed by organizational policy and guidance. In response to a question in the proposed rule seeking comment on whether the proposed rule would benefit a federal credit union's mortgage loan servicing operations, many commenters identified benefits to the expanded investment authority. Most stated that the proposed rule would provide flexibility for federal credit unions to operate their mortgage loan business and would provide federally insured credit unions another avenue to sell their MSAs, which could generate a higher selling price and keep MSAs within the credit union system. Several commenters noted that the additional flexibility would provide more options for smaller institutions that want to grow and sell their mortgages, as well as providing growth opportunities for the federal credit unions that purchase those MSAs. Similarly, another commenter stated that MSAs can potentially provide an ongoing stream of income to the bottom line, provided that the credit union understands and prepares for potential risks involved. Other commenters found that the rule would encourage more cooperation between credit unions, allowing them to work together from a servicing perspective. Several commenters stated that the expanded authority would offer federal credit unions opportunities for economies of scale. One that smaller credit unions may seek to partner with their larger marketplace colleagues to enter the MSA marketplace. A large federal credit union stated that credit unions, which service their own mortgage loans, devote significant resources to meeting the operational and compliance responsibilities associated with mortgage servicing. The commenter suggested that if these fixed costs can be spread over a larger mortgage servicing portfolio, credit unions will be able to execute their mortgage lending businesses more effectively. This commenter also noted that while mortgage servicing is a complex undertaking, purchasing MSAs will not add incremental risk for federal credit unions or the National Credit Union Share Insurance Fund, because the risks associated with this new authority are similar to those already assumed as part of mortgage lending. Rather than adding risk, the commenter stated that purchasing MSAs will allow federal credit unions to better address the inherent liquidity and interest rate risk posed by mortgage lending, and such risk mitigation will better protect the Share Insurance Fund. The proposed regulatory text in the proposed rule set out 3 prerequisites in order for a federal credit union to purchase MSAs from a federally insured credit union. 1, the underlying mortgage loans of the MSAs are loans the federal credit union is empowered to grant. 2, the credit union purchases the MSAs within the limitations of its board of directors' written purchase policies. And 3, the credit union's board of directors or investment committee approves the purchase in advance. 6 commenters explicitly supported these 3 conditions, finding the criteria to be appropriate. One commenter, however, found the requirement that MSAs be purchased within written purchase policies and that the board of directors or investment committee approve the purchase to be unnecessary. The NPR also included several questions regarding whether the rule should include other conditions such as capital requirements, concentration limits, or other measures to address consumer financial protection, compliance risk, and liquidity risk. The feedback the agency received on these questions was varied and addressed in detail in the final rule preamble. This concludes my summary of the comments. I will now hand the presentation over to Senior Capital Markets Specialist John Nilles, who will discuss the final rule. John?
Thank you, Ian, and good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. Final rule includes the 3 requirements proposed in the NPR, as Ian has just covered. We note these conditions are similar to those found currently in NCUA's Eligible Obligation Rule 701-23. Furthermore, like purchases of non-member eligible obligations from other federally insured credit unions, this authority is not limited to the purchase of MSAs for which the underlying residential mortgage loan is made to a person in the credit union's field of membership. The final rule, however, adds a condition that the FCUs purchasing MSAs must have a CAMELS composite rating of 1 or 2 and a management component rating of 1 or 2 as of the most recent examination. We believe this additional requirement is a significant factor as to whether the FCU has a risk management framework in place that is capable of managing the consumer compliance, concentration, and liquidity risks associated with this authority. We call to your attention that the final rule refers to the CAMELS rating instead of the CAMEL rating, as noted in the preamble of the NPR. Effective April 1st, 2022, the NCUA supervisory rating system will change from CAMEL to CAMELS by adding the S, sensitivity to market risk component, to the existing CAMEL rating system. As such, we have proposed an effective date of April 1, 2022 for this final rule. The final rule, therefore, has 4 conditions in order for a federal credit union to buy MSAs from other insured credit unions. In addition, capital adequacy changes for complex credit unions that will be effective for January 2022 require a deduction to the risk-based capital numerator for MSA balances that exceed 25% of the capital numerator, with the remaining balance risk-weighted at 250% in the RBC denominator. Lastly, parallel to this regulatory framework, the Office of Examination and Insurance will work jointly with the Office of Consumer Financial Protection, the regional offices, and the Office of National Examinations and Supervision to finalize a new examiner's guide chapter devoted to mortgage servicing that also includes detailed examination procedures to assess the risk profile of the mortgage servicing platform. The intent of this guide is to provide additional support for examiners in evaluating purchased MSAs and, as well, to communicate to examiners the supervisory expectation that FCUs have effective compliance management systems in order to comply with servicing-related consumer financial protection laws and regulation. That concludes our remarks, and we are happy to answer any questions you may have.
Thank you for your presentations, John, Tom, and Ian, and for your hard work in bringing this final rule to the NCUA board today. As many may remember, I voted against the notice of proposed rulemaking on mortgage servicing rights when it came before the NCUA board late last year. I stated at the time that I was not necessarily signaling my opposition to a potential final rule. Instead, I said if the final rule contained appropriate and substantive guardrails to mitigate the inherent risks found in mortgage servicing, I would support the rule. Long ago, my parents, and more recently my experiences on Capitol Hill, taught me that negotiating in good faith with an open mind and open communications leads to better decision-making and ultimately better governance. That is what we have achieved here today. After working with my fellow board members, we have developed a final rule that strikes an appropriate balance. This final rule will allow federal credit unions to purchase mortgage servicing assets from other federally insured credit unions, while also installing proper safeguards to mitigate the potential risks associated with this line of business. As such, I will vote in favor of the final rule. I want to thank Vice Chairman Hauptman and his Senior Policy Advisor, Sarah Bang, and Board Member Hood and his Senior Policy Advisor, Glenwood Brooks, for working with my office to address these issues and develop the final rule we can all support. There are many inherent risks associated with mortgage servicing, such as legal, interest rate, compliance, operational, and liquidity risks, just to name a few. Credit unions engaging in this business must clearly understand the risks involved and implement internal controls and other structures to manage and mitigate such risks. As such, under the final rule, federal credit unions with a CAMELS composite rating of 1 or 2, including a management component rating of 1 or 2, may purchase the mortgage servicing rights of loans from other federally insured credit unions, provided that the underlying mortgage loans of the assets are loans the federal credit union is otherwise empowered to make. The purchase will be made in accordance with federal credit unions' written policies that address the risk found in these investments and servicing practices, and the federal credit union's board of directors or investment committee approves the purchase of the assets. Before recognizing others, I have just one question for you, John. In this final rule, we did not include specific regulatory requirements for what constitutes an effective mortgage servicing compliance management system. Instead, we will be reviewing compliance management systems through the supervisory process. What will examiners be looking for in compliance management systems? And will they have more time in risk-focused exams to sufficiently assess the effectiveness of such systems in protecting consumers?
Hi. Yes. Thank you, Mr. Chairman. This is John Ellis. I will take that question. Examiners will review whether the credit union's mortgage servicing compliance management system will include the following components: board and senior management oversight, policies and procedures, training, monitoring, member complaint responses, and an audit function. Federal credit unions who have significant mortgage servicing, including continued servicing of mortgages, can expect to see more focus in this area in future exams. As we mentioned in our presentation, with this final rule, E&I will collaborate with the regions, ONES, OCFP, and other offices in the development of this examiner's guide chapter devoted to mortgage servicing. And that chapter will also include exam procedures to assist in determining the level of risk associated with loan servicing and compliance to consumer protection regulations. We're targeting to have this chapter completed by the effective date of the final rule. This concludes my answer.
John, thank you for that answer. Again, I want to thank my board colleagues for their willingness to work with me. The result is a final rule that contains appropriate safeguards to protect consumers and manage the potential risks associated with these operations. It also provides federal credit unions greater flexibility to manage and diversify their existing mortgage servicing business lines. That concludes my remarks. I now recognize Vice Chairman Hauptman.
Thank you, Mr. Chairman. I also appreciate the shout out to me and my staff. I agree with you that we have worked together and found compromise, and I think it's something we're both inclined to do as people. We're not supposed to all agree. If we all agreed, you would just need one person on the board, but we have a bipartisan board for that reason. Thank you to the folks that put that presentation together, Tom, Ian, John. The changes in this final rule are appropriate and timely. First mortgages, which total about $500 billion, represent 38% of federally insured credit union loan portfolios. This is up from $230 billion 10 years ago. It's an increase of over 100%. More and more Americans are turning to credit unions to help them purchase their homes. This means that servicing mortgages is something credit unions have done for ages, and it's about as plain vanilla a product as exists for credit unions today. While consumers benefit from having the choice of credit unions for mortgages, the back office requirements for the credit unions can be a challenge. This rule gives credit unions the ability to scale up mortgage servicing for their own members by purchasing mortgage servicing assets from other credit unions. Those that want to focus just on lending will have the choice to sell their mortgage servicing rights to other credit unions, entities that have similar service motives and culture. This rule provides federally insured credit unions another pool of potential buyers when they sell their MSAs that could generate a higher selling price. The additional flexibility not only allows smaller institutions that want to grow and sell their mortgages to have more options to sell them, but allows growth opportunities for the credit unions that want to purchase those MSAs. Provided the federal credit union understands and prepares for the risks involved, MSAs can provide an ongoing stream of income to the bottom line. That said, this rule may not affect many credit unions, since plenty of them aren't interested in buying or selling these assets. This rule helps keep the servicing assets within the credit union system. It also supports cooperation between credit unions. That's a unique feature of the credit union movement. I'm a firm believer in regulatory clarity. This rule makes consistent the language among the regulations covering incidental powers and investments. This final rule provides more choice, growth opportunities, and another avenue for cooperation between credit unions. I'm pleased to support it. That concludes my remarks. I just have one question, and it relates to regulatory clarity. So the rule only permits federal credit unions to purchase MSAs from other federally insured credit unions. Can we explain why it doesn't permit them to buy these assets from other sellers?
Yes, this is Ian Morena. I can answer that question. The legal authority for this rule, as cited in the proposed and final rules, is found in the Federal Credit Union Act, Section 107.14, which is 12 U.S. Code 1757.14, which permits federal credit unions to sell and purchase the assets of other credit unions. And this differs from statutory authority, for example, for loan participations in that same section of the Federal Credit Union Act, which explicitly permits federal credit unions to engage in loan participations with a far broader field of participants. Under the statute and NCUA's loan participation rule, subject to some conditions, a federal credit union can purchase a participation interest in a loan from a credit union, a CUSO, or a, quote, financial organization, which means any federally chartered or insured financial institution and certain state federal government agencies. So just to wrap up, for purposes of this rule, and as cited in the proposed and final rules, the agency relied on the specific authority related to purchases of assets from other credit unions. That concludes my response.
Thank you for that thoughtful response. That concludes my questions. Back to Chairman Harper.
Thank you so much. Board Member Hood, the floor is yours.
Oh, great. Thank you, Mr. Chairman. And I also want to thank you for recognizing the hard work for my senior policy advisor, Linwood Brooks, and really work with both of the board offices to bring us here today, where we're all able to work together in a bipartisan manner. And I want to call attention to the fact that I'm very pleased with the collegiality that I now see manifesting itself throughout the NCUA board and its respective board offices. So it's very pleasing to see and experience. I'd also like to thank John, Tom, and Ian for your presentation this morning. Federal credit unions have come a long way since the NCUA created the prohibition on investing in mortgage servicing rights. The industry, size, complexity, and most importantly, its sophistication have all grown tremendously since then. Originating and servicing residential mortgage loans is an important activity for many credit unions. Many of them already service loans that have been sold to investors. The time has indeed come for NCUA to permit federal credit unions to purchase mortgage servicing rights from other federally insured credit unions. The ability to do this will provide flexibility for federal credit unions to manage their mortgage servicing lines of business and create liquidity in the credit union system, while also providing a more diverse business and investment opportunity for purchasers of mortgage servicing rights. Both sellers and purchasers of mortgage servicing rights can benefit from this proposed rule indeed. Today's final rule removes the prohibition on FCUs from purchasing mortgage servicing rights in the investment rule. As of June 2021, federally insured credit unions collectively sold and serviced $270 billion of mortgage real estate loans, with federal credit unions accounting for 53% of the total balance. Comparatively, approximately 1,100 federally insured credit unions collectively sold $63 billion in residential mortgage loans in 2019, with 556 federal credit unions accounting for $39 billion of the total amount sold. If a credit union wants to purchase mortgage servicing rights from another credit union, I'm delighted that today's rule allows the institutions we regulate to keep this capital safely in our credit union system. I further believe today's rule does not increase the risk for the National Credit Union Share Insurance Fund, while also improving price transparency for our MSRs. I view it completely as a win-win and enthusiastically support today's rule. Thank you, Mr. Chairman. I have no questions.
Thank you, Board Member Hood. Is there a motion?
Yes, I move that the board approve final rule part 703 of NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion?
Yes, sir. I second the motion.
There is a sufficient second. All those in favor say aye. Aye.
Aye.
All those opposed say nay. And the ayes have it, and let the record show that the motion passed 3-0. The fourth item on our agenda today is the NCUA's 2022 and 2023 budget. Staff presenting, Eugene Sheed, Chief Financial Officer, Eugene, you may begin when you're ready.
Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. I'm Eugene Sheets, and before you this morning to present the recommendations for the 2022-2023 budget. The staff draft 2022-2023 budget justification was posted to the NCUA website on November 17, 2021, and also published in the Federal Register on November 24th. Compared to the overall funding and staffing levels in the staff draft budget, the recommended final budget before you today is reduced by $0.9 million and reduced by 46 full-time FTE in both the 2022 and 2023 operating budgets. The recommended final budget is for a total budget, including the operating, capital, and share insurance fund administrative budgets, of $339.5 million and 1,196 FTE. The recommendation also includes the approval to use $23 million of unspent 2021 budget funds in 2022. The 2023 budget would increase over 2022 by $41.8 million. However, $23 million of this is the result of the use of the carryover I just mentioned to offset the 2022 budget, which would not be available in 2023. Even though the board adopts a two-year budget for planning purposes, it has been its practice to revisit each year's budget before that budget year begins. The operating fee collected from federal credit unions would also further be reduced by $15 million due to the accumulated cash in excess of funding needs. I will now discuss some specific changes to the draft budget. The funding levels in the 2022 staff draft operating budget, as I mentioned, would be reduced by $5.9 million for a revised operating budget total of $320.1 million in the recommended final budget. This is a level 1.8% higher than the board-approved 2021 operating budget. Staff would be reduced by 46 FTE as compared to the draft budget. Specific changes from the staff draft operating budget are as follows. The 29 additional examiner staff and their associated costs that were added to the 2022 staff draft budget for proposed changes in the examination scheduling parameters and for certain credit unions has been eliminated in the recommended final budget. The examination scheduling parameters would remain unchanged for from 2021. The increase to the cadre of specialist examiners by way of converting examiner positions as proposed in the staff draft budget is retained in the recommended final budget. However, the increase of 3 examiner FTE to adjust for productive work time is reduced by 1 FTE to a net of increase of 2. The 2 small credit union program officer FTE proposed in the draft for the Office of Credit Union Resource and Expansion has been modified. Instead, 3 examiner FTE, 1 per region, are included in the recommended final budget to support the needs of small credit unions. The 4 fair lending staff for the Office of Consumer Financial Protection to increase fair lending exams and supervisory contacts proposed in the draft has been reduced to 2 FTE in the recommended final budget. The 1 additional financial inclusion and outreach analyst in OCFP remains in the recommended final budget. However, this position would initially be term limited to not more than 3 years. The staffing changes proposed in the staff draft budget for the Office of Examination Insurance, other than the reduction of the FTE connected to the end of the NCUA Guaranteed Notes program, those other positions have been removed from the recommended final budget. The proposed addition of 1 speechwriter for the Office of External Affairs and Communications in the staff draft budget has also been removed. The budget expenses has been reassessed and recommended in the final budget reduces travel by $2.7 million as compared to the staff draft. Finally, the final budget recommendation before you today does make a small increase to accommodate for the fees that the NCUA pays for the Federal Financial Institutions Examination Council, FFIEC, which they have informed us will increase $220,000 over the previous estimate. The staff draft budget proposes the resources necessary for examiners in the NCOA regions in conjunction with ONES to continue to supervise credit unions with reported assets between $10 billion and $15 billion in 2022. This is retained in the final budget recommendation. The corresponding regulation change to the $10 billion threshold for consumer credit unions to be supervised by ONES will be taken up by the NCOA board in 2022. The recommended final 2022 and 2023 capital budgets are unchanged from the staff draft and remain at $13.1 million for 2022 and 23. This, again, is 31% below the 2021 budget. The recommended final 2022 and 2023 Share Insurance Fund administrative budgets unchanged from the staff draft and remain at $6.2 million and $4.8 million respectively. This 2022 budget would be 22% below the comparable 2021 budget. I will now turn to addressing some of the comments from the public. NCOA held the budget hearing on December 8, 2021. At that meeting, representatives from 4 different associations presented their views on the draft budget. The NCOA also received written statements from 3 additional organizations. All written submissions are posted on the regulations.gov website. Many of the general comments received from the public about the budget relate to NCOA operations and program execution and not directly on the budget itself. My office will provide these comments directly to the appropriate NCOA offices for their consideration and potential action. 4 commenters criticized the 3.6% growth for the operating budget in the draft. As I've noted, the draft budget has been reassessed, and the recommended final 2022 operating budget is $320.1 million, or $5.9 million less than the draft. Overall, the board-approved budgets across the 3 would decrease by $1.9 million in 2022 as compared to the budgets approved by the board in 2021. The changes, as were outlined above, are largely driven by the reduction of the 46 personnel from the staff draft budget and the additional reduction to the travel budget. 4 commenters requested additional information about the new examiner positions proposed for 2022. The recommended final operating budget removes the 29 examiner positions proposed in the staff draft that would have resulted from changes in the examination scheduling parameters. Several commenters encouraged the NCOA to provide a more thorough justification for new positions. The final budget document will be updated to provide more detailed explanation for the new positions that remain. The NCOA will also ensure that future budget documents provide more details and, where possible, quantitative analytics for new NCOA positions. 4 commenters raised concerns about the proposal for the 4 new fair lending related positions. The final includes 2 of the additional staff to expand the NCOA's fair lending program. Existing resources allow for only 30 fair lending exams per year. Fair lending violations continue to be uncovered, warranting some additional resources to conduct these reviews and address any violations identified. 1 commenter requested that the final budget include an updated spending estimate for 2021. The staff draft and the recommended final operating budget effectively do this by projecting a $23 million surplus, which is the most current and best estimate related to how spending will end up for 2021. 1 commenter requested any surplus balances in the operating fund be returned to credit unions directly or via a credit against 2022's fee. The operating fee schedule reflects a credit of $15 million, which contributes to what would be an average estimated 2022 operating fee rate reduction of 23.7% as compared to 2021. 3 commenters expressed concern over the proposed $20.8 million travel budget. The travel budget assumptions have been updated. and the recommended final 2022 operating budget has been reduced. Based on the updated expectations for staff travel in 2022, the revised travel budget would be $18.1 million, or a reduction of $2.7 million from the staff draft budget. One commenter expressed continued support for the NCOA's Access Initiative and encouraged the agency to ensure that CURE has sufficient resources in 2022. The final recommended budget replaces the 2 CURE positions proposed in the staff draft with an extra 1,000 hours, which equates to 1 extra examiner FTE in each region to support small credit unions. Within existing resources, CURE will undertake a study in 2022 to determine the options for and design of new credit union outreach programs. Other resources in CURE would be maintained at current levels. One commenter recommended 2 specific revisions to footnotes in the staff draft. We agree that these suggestions add clarification and will make changes in the final document. One commenter recommended that the budget justification document greater transparency about cybersecurity expenses. The NCOA will review how cybersecurity program expenses are explained as part of the development of the 2023-2024 budget cycle. And one commenter questioned the capital budget allocation methodology and application of Principle 1 of the overhead transfer rate, or OTR. As discussed at the public budget briefing last week, the change to the operating fee methodology, allocating a portion of the capital budget to the OTR, as approved by the board in 2020, only altered the timing of the OTR payments for capital projects, not how much of the total the OTR would pay for capital assets. The NCOA will look to provide a better explanation for the drivers behind the year-over-year OTR changes in budget documents going forward, rather than just reporting on the level of each year's change. Finally, a note on financing the NCOA's programs. The NCOA's expenses are funded primarily through fees paid to unions and transfers from the Share Insurance Fund using the OTR. As the annual budget is developed for board review and approval, the approved methodologies for calculating the OTR and the operating fee are applied to determine the amount of the budget that will be financed by each. To promote transparency about how the NCOA finances its programs, pages 52 through 59 of the draft budget justification includes a discussion of these methodologies. The OTR estimate presented in the staff draft budget has changed as a result of the revisions to the draft budget that I have already mentioned. The final 2022 overhead transfer rate is 62.7%, which is 70 basis points lower than the draft budget, but also an increase of 40 basis points from the 62.3% rate calculated for 2021. The residual 37.3% of the 2022 budget will be collected through the operating fees. In 2022, federal credit unions will cover 68.6% of the cost of the NCOA's operations, while the FISCUs will pay 31.4%. Based on the current operating fee methodology, which took effect in early 2020, the operating fee charged to federal credit unions will decrease by 23.7% as compared to 2021, a 1,250 basis point from the estimate provided in the staff draft, which is mostly attributable to the $15 million credit that's available from unspent cash already in the operating fund, as well as changes to average asset growth assumptions. Federal credit unions with assets of less than $1 million are not assessed the operating fee. For federal credit unions with assets greater than $1 million, the NCOA establishes a 3-tier scale to compute the fee charged, also known as the assessment scale, which is adjusted annually based on asset growth. To conclude, the board action memorandum details the changes I have presented and includes an attachment that shows the budgets by office and budget element and an updated comparison of the shares of the budget funded by the OTR and the operating fee, as well as the operating fee calculation worksheet and updated scale. An updated 2022-2023 budget justification with the final budget approved by the board would be published on the NCUA's website when complete. The budget justification will be updated to explain the reductions made in the final budget proposal and to address, as I've mentioned, relevant public comments. This concludes my remarks, and I recommend on the recommendation for the 2022-2023 budget, and I will now be glad to answer your questions.
Thank you. Let me begin by expressing my thanks to everyone involved in developing and finalizing the recommended NCUA 2022 and 2023 budget. Thank you, Eugene, Melissa, Jim, and the entire team in the Office of the Chief Financial Officer, as well as the Office of the Executive Director. A tremendous amount of work was done by all. I'm also very appreciative of my fellow board members and their teams. Their willingness to engage with me in good faith discussions about each of our priorities helped us to reach a consensus in the recommended budget before us today. And last week, the board held a public hearing on the 2-year staff draft budget and received testimony from 4 groups. Additionally, the agency received 6 comment letters on the staff draft budget. That input is integral to our annual budget process. Thank you to all who participated and provided that feedback. Notwithstanding the tight time frame, be assured that the NCUA team carefully reviewed and considered your comments and testimony and incorporated some of your suggestions into the final recommended budget. As I noted earlier, the recommended budget we are considering today is a consensus product that evolved from the staff draft. Compared to the overall funding and staffing levels shown in the staff draft budget, the budget we are considering is smaller in dollars and full-time equivalents, but it still achieves the important goals of protecting credit union members, maintaining the safety and soundness of the credit union system, and safeguarding the Share Insurance Fund. As Eugene noted, the recommended overall total budget, including the operating budget, the capital budget, and the Share Insurance Fund administrative budget, is $339.5 million with 1,196 full-time equivalents. This final budget also reflects a carryover of $23 million of unspent 2021 budget funds for the operating budget. Together, the total budgets with the carryover, the agency will increase spending by 4.1% in 2022 compared to the 2021 budget, an amount lower than the annual rate of inflation. Additionally, under this budget, the operating fee collected from federal credit unions would be further reduced by $15 million due to accumulated cash exceeding funding needs. This reduction to the operating fee lowers the amounts that will be invoiced to federal credit unions for the operating fee collection due April 15, 2022. I know this issue was very important to Board Member Hood, and I appreciate his steadfast focus on this matter. Other highlights of the recommended budget include more resources for small credit unions. This was a high priority for me. Small, low-income, and minority credit unions are vital to the continued health of the credit union system, and they are often the only providers of safe, fair, and affordable financial services in communities of color, underserved areas, and rural neighborhoods. And while we have resources dedicated to supporting low-income and minority credit unions, in recent years we have pared back our assistance for small credit unions. This budget reverses that trend by adding 3 examiner positions, 1 per region, in the recommended final budget to support the needs of small credit unions. In 2022, staff will study and consider other options for further supporting small credit unions in the future. Additionally, I remain deeply committed to strengthening the NCUA's consumer compliance and fair lending programs to ensure that consumers receive the same level of protection regardless of their financial provider of choice. While I would have liked to increase our fair lending resources by more, the recommended budget includes 2 additional staff to expand the NCUA's fair lending program. Existing resources allow for just 30 fair lending exams a year. Additionally, exams and other touch points are needed because we continue to identify fair lending violations. Additional resources will allow us to ensure that the credit union system lives up to its ideal of people helping people by ensuring the fair treatment of all consumers. The NCOA COVID-19 response will continue to be a focus for the agency next year. Almost 2 years into the pandemic, the NCOA remains focused on keeping its employees and contractors safe so that we can continue to perform the agency's mission-essential functions. We have pragmatically and expeditiously addressed the economic fallout within the credit union system by providing appropriate regulatory flexibility, and we will continue to do so. On cybersecurity, we all remain deeply vigilant about the risks that cyber attacks pose to our financial system. We will continue to mature and strengthen our cybersecurity program and make it appropriately transparent under this budget. Finally, we must remain vigilant when it comes to safety and soundness. With the expiration of pandemic relief programs, more households will come under financial stress next year, and that stress can lead to credit defaults at credit unions. To best protect the system and the Share Insurance Fund, the recommended budget maintains the current exam program, which allows for extended exams at well-run credit unions with less than $1 billion in assets. Maintaining at least the current exam policy was critical to gaining my support for the final budget. In conclusion, it was a pleasure to work with my fellow board members and their senior policy advisors, as well as the agency's budget staff, to find common ground between us on the recommended 2022 to 2023 budget. The final budget does not give each of us on the board everything we wanted, but it does give the agency everything it needed. I look forward to a productive 2022. That concludes my remarks. Vice Chairman Haltman.
Thank you, Mr. Chairman. Thank you, Eugene, the team in the CFO's office. Also want to thank Larry Fazio, my fellow board members, for their willingness to find common ground here. During the budget hearing last week, I said the draft budget is just that, a draft, and I expected it to evolve before we voted on it today. One of my biggest concerns then was headcount. The proposed number at that time of 48 new full-time employees represented more than $66 million over 10 years, and that's before pay raises, inflation, bonuses, anything else. My first board meeting 1 year ago, and in almost every board meeting since then, I've said that we should know that every dollar we take is obviously the money of a credit union member. Every bit we spend could be food on some family's table. It could be a birthday present for a kid that doesn't have much, or a bus ticket to go see a sick relative for the final time. We need to be able to look those folks in the eye and tell them that what we spent was worth it. We shouldn't demand money from hardworking people and say, we're going to spend it better than you would. So I'd just like to reiterate how high the bar should be for us to take money from credit union members. Every dollar NCUA spends is no longer at a credit union earning a return. When we take a dollar from a credit union, the cost isn't just that $1. The cost is also all the future earnings that dollar could have earned if it stayed at a credit union. So it's in that spirit we should approach our budget process. I'm pleased that the final budget we're discussing today is considerably lower in both headcount and total spending. The revised comparison to 2021, if we take out the carryover, is a reduction of $1.9 million, just under 1%. As I also said last December, when we spent less money because of travel, any reduction in government budget is quite remarkable. Every once in a while, even government agencies have to live with the same financial constraints as everybody else. I applaud staff and management for working with the board to achieve this. This revised budget places more emphasis on assisting small credit unions. I think we all agree this is needed. As we emerge from the pandemic, smaller institutions with fewer resources will benefit from immediate and effective support from NCUA. No matter how well-intentioned NCUA staff here in Alexandria are, we're not always equipped to deal with the intimate knowledge needed to act quickly to assist a particular credit union. It's the people closest to those challenges, our field examiners, who are. But that takes resources, and I'm grateful for the addition of 3,000 examiner hours dedicated to working with small credit unions. I'm especially pleased because this strategy allows us to track our effectiveness. We shouldn't look at a small struggling credit union and keep defaulting to pushing them into a merger. If our regulatory approach means that a community can't have their own small credit union, then we need to re-examine our commitment to diversity and inclusion. Measuring the effectiveness of the dollars we spend is important. Credit unions have to carefully consider the return on investment of their resources, so we must do the same. Finally, I support Board Member Hood's call to return excess funds in the operating budget back to the credit unions. The buildup of cash and the net fund balance reserves in the operating fund is money raised by NCUA's operating fee on credit unions. This annual fee is intended to pay the agency's annual expenses. It's not intended to build up reserves. We all appreciate the effort to conserve budget dollars, but we should work towards a consistent method for returning excess funds when they reach certain levels, similar to how we have an established process to return excess funds in the Share Insurance Fund. Returning $15 million of the excess cash to offset the operating budget is a step in the right direction. I have no further comments. A couple questions for Eugene, though. One is, last week I expressed my concern that the amount of time the budget was out for public comment was a bit short. When this process is rushed, it can give the appearance that public comment isn't really welcome and that our budget hearing isn't intended to actually affect the final product. What are we going to do to help ensure this does not repeat next year?
Thank you, Vice Chairman. This is Eugene. And I would say a little of what happened this year is, as we were going through and scrubbing each office's budget request and trying to analyze and think ahead about what was going to be needed, frankly, we just fell a couple of weeks behind in our analytics. As a result, the comment period was, instead of 4 weeks, which it was the previous year, was just over 3 weeks, which I agree is really too short because, as you said, it can send really the wrong message. So I think just simply better planning out front of what the project plan is and the commitment to stick to that plan and the fact that really 4 weeks sort of should be viewed as the minimum as to what's needed will help us for next year. That concludes my response.
Thank you for that. Yeah, and I acknowledge that the months of November and December, because of the holidays, we have a slightly earlier board meeting than we normally do, so it kind of sneaks up on us. Regarding the comments we got on the budget, the amount and the type, can you compare that to last year?
In terms of the comments and the amount and type, so it was actually the same number. We actually heard from 7 different organizations, which was the same as the previous year, and that was down about 3. I think we had 10 general comments from folks, organizations in 2020. And I would say the substance overall was good. Recognizing that we put folks under a short time frame, I think that particularly from the 4 folks that presented, 4 organizations that presented last week, I thought they had some very thoughtful comments, and I would say that they were similar themes to what we've heard in previous years. Obviously, in particular, concern about any budgetary growth and us justifying that as a part of our process. That concludes my answer.
Do the comments tend to say, we think you guys should spend a whole bunch more of our money?
I don't think that I've ever seen that comment. We'll occasionally get something like we do occasionally for CURE, supporting maybe a particular initiative. But no, they generally don't. They're generally criticizing any budget growth and wanting us to explain it.
Yeah, I hear you. I'm not saying who's right or wrong, but as a general matter, person who pays money tends to think it's a lot. Person who receives the money tends to not think it's that much. Let me ask you this. This is a 2-year budget. What can we expect prior to year 2, before 2023? Has the second year of the 2-year budget ever just gone into effect without the board revising it?
Okay, so Eugene again, and good question. So to my knowledge, no, and certainly not in the 4 budget cycles I've been a part of. We do a 2-year budget to try and help plan and forecast what's coming ahead. But I think most organizations that engage in 2-year budgeting, their governance body usually reassesses, as they should, what's happening for that second year and revises the plan, much like the board also does when we do mid-session each year. So really about every 6 months we're reassessing where we're at and what we need to do.
I gotcha. And so if we couldn't get our act together to do this budget today, we would at least have a fallback plan for next year to keep the lights on, et cetera. I gotcha. That concludes my remarks. Back to Chairman Harper.
Thank you, Mr. Vice Chairman. Board Member Hood, you're up.
Great. Thank you, Mr. Chairman. And I certainly want to thank Eugene and all of his colleagues there in OCFO for their great hard work and diligence in getting together today's budget. And also Larry Fazer, who also played a really strong role in getting us all here today. And also want to thank the board offices. I really do think that we were able to collaborate and really work to really get the budget in a good spot. And as the chairman said, not everyone got what they wished to have, but I'm glad, though, that we were able to get there through collegiality and, again, bipartisan support. With that being said, I must say, though, everyone, the budget is not perfect. In fact, it's not the budget I would have put forth if it was completely up to me. However, it does reduce spending year over year when you look at all three budget accounts holistically with the travel carryover from 2021, and it makes sensible changes in NCUA's headcount year over year. And finally, as something that I've been asking for quite some time, it does give money back to credit unions from our operating fund. So this is a budget that I can fully support. Eugene, and working with you on the operating fund carryover balance throughout the year, can your office possibly recommend procedures for the board to consider so we do not find ourselves in a similar situation in the future? I noticed that some of the operating fund balances go back as far as 2015. So it's clear that we need to have some procedures in place to manage this fund on behalf of the board.
So yes, what I would suggest is I think a practice that existed a number of years ago is to consider, as a part of the development of a draft budget, a look at the cash balances like we did this year, to then, as a part of that budget, put forward a recommendation about what they are and an assessment of what could be returned. I think that practice stopped for a few years because there was some concern about the methodology and frankly, I think a concern about that there was not sufficient cash. But obviously, in the intervening 5 or 6 years since that's last happened, there has been this buildup. I think a sensible approach would be to make this a regular part of the annual budget consideration. Thank you.
Well, that's something I would clearly support, so thank you, Eugene. And Eugene, for credit unions that do pay into the operating fund, what kind of rebate can they expect this year?
So as we develop the invoice for this year, first that'll be about almost 24% lower than it was, so the scale will go down. And we plan, as a part of the invoice, to see if we can show clearly what everyone's particular share is of the $15 million, so they can see what they would have been assessed before, and then what the actual assessment is with their specific credit, so to speak, included.
Well, I'm delighted that. Well, thank you, Eugene. I'm delighted that we found a solution. As you know, my first priority was that we could perhaps give them old-fashioned checks or electronic payments. But at the end of the day, we are able to provide them with $15 million in funding back. So for that, I'm most appreciative. As I said earlier this month, when we did have our public briefing, when I was last on the board, the NCUA regulated just over 7,500 credit unions. Recently, we reported through our most recent call report data that we oversee credit unions now. It's less than 5,000 credit unions. And while the number of credit unions we regulate has fallen since I was last on the board, the NCUA budget has exponentially increased in the same time frame. While credit unions have become more complex, I believe more should be done to respond to the changing nature of the credit union industry, which should be reflected in NCUA's budget. However, I do appreciate, once again, the work of all three board offices in producing today's budget. Yes, it's far from perfect, but it is acceptable. Going forward, I do believe we can seriously improve on the timing for this budget. While the board offices did negotiate in good faith for several weeks, I do think we needed more time to study the budget, especially since today's budget is radically different from the staff budget that we reviewed earlier this month. I will also make the point that while we did not come to an agreement on having an advisory board that I requested in today's budget, all three board offices have the funding to conduct town halls and roundtables as they deem appropriate. So I hope if these prove to be successful, we can continue to someday consider an NCUA advisory board. In closing, again, I'd like to thank all of the folks from OCFO and Larry who worked on this proposal today. I know that nearly every other office contributed to the development of the budget, and several others helped to make the budget hearing such a success. So thank all of you for all of your hard work as well. I have no further additional questions or comments, so thank you, Mr. Chairman.
Thank you so much, Board Member Hood. And I certainly know one town hall I would like to see done is on small credit unions and what can we do to support them. Probably may want even to do a series of those. And also to both of your very good suggestions. Ideally, I would like for us to get to a place where we're considering the budget in November, which has additional lead time, that we're seeing the budget earlier in the process. I think that would help us because then we can spend the last month of the year finalizing a performance plan based on that budget, as well as working to develop supervisory priorities. It all sort of comes together here at the last year, and if we could give ourselves a little space, I think that that would be helpful. Is there a motion?
Yes, Mr. Chairman, there is, but before so, Mr. Chairman, I'd like to just thank you as well for your willingness to work with my office and the Vice Chairman's office on a FinTech rule, something that I look forward to doing in 2022. And with the roundtables, I know you want to do one on small credit unions. I intend to do one around access and our MDIs and possibly one on FinTech. But again, I wanted to recognize and thank you for your willingness to work with the other two board offices around a FinTech rule, since that's getting so much attention in our industry.
Indeed.
With that being said, I now have a motion, and it's a long one. I move that the board approve, one, the 2022 operating budget of $320,138,000 and 1,196 full-time employees, FTEs, and the 2023 operating budget of $363,426,000 and 1,204 full-time employees, or FTEs. Two, the 2022 capital budget of $13,069,000 and the 2023 capital budget of $13,069,000. And three, the 2022 share insurance fund administrative budget of $6,246,000 and the 2023 share insurance fund administrative budget of $4,770,000. And four, the $23 million that $23 million from unspent prior year budgets is available for expenditure in 2022 from the operating fund for contracted services and related expenses. And five, that $15 million of cash in the operating fund be returned to federal credit unions in the form of a credit reduction to the 2022 operating fee schedule, all as detailed in the board action memorandum.
Is there a second to the motion?
Yes, sir. I second the motion.
There is a sufficient second. All those in favor say aye. Aye.
Aye.
All those opposed say nay. And the ayes have it. And let the record show that the motion passed 3-0. The fifth and final item on our agenda today is Final Rule Parts 702 and 741, Subordinated Debt. Staff presenting, Rick Mayfield, Senior Capital Markets Specialist, Office of Examination and Insurance, and Justin Anderson, Senior Staff Attorney, Office of General Counsel. Rick and Justin, please begin.
Good afternoon, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. This is Rick Mayfield from the Capital Markets Division of the Office of Examination and Insurance. I am joined today by Justin Anderson, Senior Staff Attorney from the Office of General Counsel. We are here to present you with present for your approval a final rule to amend the pending final subordinated debt rule, which is effective January 1, 2022. At the September board meeting, the board proposed two narrow changes to the subordinated debt rule. The proposed changes were designed to assist eligible credit unions in the transition to a new subordinated debt rule as it relates to 2021 approved secondary capital plans and the investments into those credit unions from the U.S. government programs. For example, the Emergency Capital Investment Program, or ECIP. ECIP invests money into minority
sort of process improvement moving forward. This is the OTR.
We have somebody who is in the call.
This year we had sort of a tall order to redesign.
Okay, I think we're set now. So ECIP invests in minority depository institutions, MDIs, or Community Development Financial Institution Credit Unions, CDFIs. Justin will discuss the details of the proposed and final rules following my remarks. The ECIP program, established by the Consolidated Appropriations Act 2021, was created to encourage low and moderate income community financial institutions to augment their efforts to support small businesses and consumers for communities. Eligible financial institutions include any MDIs or CDFIs that are federally insured credit unions and are not designated in troubled condition. MDIs and CDFIs are lenders to low and moderate income communities, and their efforts provide financial products for small and minority-owned businesses and consumers in low income and underserved communities. Congress has appropriated a total of $9 billion for the ESIP program, and there are set-asides at different levels of total assets. Eligible credit unions were required to submit an ESIP application to Treasury. The deadline for this application was September 1, 2021, which was extended a couple times over the course of 2021. Once approved, Treasury will invest in the form of subordinated debt into those credit unions in accordance with the prescribed term sheet of the transaction. All of the details can be found on Treasury's ESIP website. Credit unions who are approved for ESIP and also have a low income designation, or LICU, were separately able to apply for secondary capital treatment. An approved plan provides LICU credit unions the ability to augment their net worth for the purpose of PCA classification. Given the complexity of potential dual application process, including the ESIP application and the secondary capital application, NCUA is collaboratively working with Treasury and state supervisors, when applicable, in managing the application and decision process. This concludes my remarks, and I will hand it over to Justin to discuss the proposed and final rules.
Thank you, Rick, and good afternoon. This is Justin Anderson, Senior Staff Attorney, Office of the General Counsel. Currently, the subordinated debt rule contains a requirement that any secondary capital that is not issued by January 1st, 2022 will be treated as subordinated debt and subject to the requirements of that rule. In the context of today's presentation, this provision would require LICUs to reapply for regulatory capital treatment if the investment under the ESIP program is not funded by year's end. To address this issue, the proposed rule issued by the board in September made two very narrowly tailored changes. These changes would address the transition to the new subordinated debt rule for LICUs participating in the ESIP or other similar U.S. government. Specifically, the proposed rule did the following two amendments. First, the proposal amended the term grandfathered secondary capital to include any secondary capital that is, one, being issued under a secondary capital plan that is approved by the NCUA before January 1st, 2022, and two, being issued to the United States government or its subdivisions. Secondary capital that meets those two criteria would not be subject to the new subordinated debt rule, regardless of when the actual issuance takes place. Second, the current subordinated debt rule provides that grandfathered secondary capital will retain its regulatory capital treatment for a period of up to 20 years from January 1st, 2022. To ensure equitable treatment of grandfathered secondary capital, the proposal revised the start date for the 20-year period to the later of the date of issuance, or January 1st, 2022. The proposal was issued with a 30-day comment period. In response, the NCUA received 15 comments. None of the commenters objected to the proposed changes. As such, this final rule is identical to the proposed rule approved by the board in September. I'd like to note, however, that while no commenter objected to the proposal, all of the commenters did offer comments that were outside the scope of this rulemaking. The preamble to this final rule does note that the agency will retain these additional comments for the use in designing any future amendments to the subordinated debt rule. This concludes our prepared remarks, and we are happy to answer any questions. Thank you.
Thank you, Justin, and thank you, Rick, for your presentation on the Subordinated Debt Emergency Capital Investment Program final rule. As noted in your presentation, this final rule is substantially similar to the proposed rule, and this rule received support from all of the stakeholders who weighed in during the comment process. Justin and Tom, this widespread support resulted from your excellent work in putting together this targeted and much-needed rule in a very short time frame. Thank you both for a job well done. This final rule will benefit eligible low-income credit unions that are participating in the U.S. Department of Treasury's ESIP, as well as other programs administered by the U.S. government that can be used to fund secondary capital. Specifically, this rule provides that the expiration of regulatory capital treatment for these issuances is the later of 20 years from the date of issuance or January 1st, 2042, as long as the agency approves those secondary capital plans by December 31st. The pandemic-induced recession hit communities of color and the poorest households the hardest. And with the expiration of several pandemic relief measures and rising prices for essentials like food, energy, transportation, and housing, many of these households will soon experience financial stress. In fact, just last week, the New York Times featured an analysis about how the excess savings rate for the lowest quartile of households is quickly dwindling. The decline in cash reserves for these households has, quote, vast implications for the working class and could dampen consumer spending, a large share of economic activity. In creating ESIP, Congress created a lifeline to support these underserved communities and help them recover from the pandemic. And on Tuesday, the Treasury Department announced that 85 credit unions will receive billions of dollars in ESIP funding. The amount of these allocations ranged from less than $1 million to more than $200 million. The funding provided by ESIP will be a game changer for participating MDI and CDFI credit unions and their communities. These institutions are often the only federally insured institutions in underserved areas, rural districts, and communities of color. Participating credit unions will leverage ESIP funds to lend to startup small businesses, back eligible community development projects, and offer car and home loans. And over time, the impact of these funds will grow exponentially as members pay back those initial loans and participating credit unions make new loans. However, CDFIs and MDIs cannot and should not bear this burden alone. In the months ahead, I encourage all credit unions to support safe, fair, and affordable lending to their members. With a cooperative structure and a statutory mission of meeting the credit and savings needs of members, especially those of modest means, all credit unions have a moral obligation to step in and step up to support the needs of their members, local businesses, and communities. These actions will ensure a more stable economic recovery and foster greater economic opportunity. That is good for all Americans, and it is good for our democracy. Finally, after today's vote, we will still have one more step to complete to allow participating credit unions to maximize the use of ESIP funding. In a rulemaking next year, the NCUA board will act to permit ESIP funding to count as regulatory capital for the entire time that it is held, a total of 30 years, instead of the current regulatory cap of 20 years on secondary capital. I look forward to working with my fellow board members on this important work. That concludes my remarks. I now recognize Vice Chairman Hauptman for any comments or questions that he may have.
Thank you, sir. I want to thank Justin, Rick, rest of the team for this update. Real team effort here. I urge CDFIs and minority deposit institutions to take advantage of this funding when the ESIP program was first publicized. Among other benefits, it raises the visibility of credit unions in underserved communities. In times of crisis, credit unions are there for their members. For CDFIs and minority deposit institutions, credit unions, it's more than providing financial services. CDFI and MDIs go beyond the members to engage with community leaders. They coordinate with businesses. They create coalitions to support those in need. It's a vivid demonstration of the power of cooperation in our communities. Assuring this funding can be treated as grandfathered secondary capital will help CDFI and MDI credit unions do that. The delay in funding approved applications created a challenge for credit unions and for this agency. Under our existing subordinated debt rule, those funds would not be grandfathered in as secondary capital, but be treated as subordinated debt. But with today's adjustment, credit unions whose secondary capital applications are approved by NCUA in 2021 will be able to treat those funds as grandfathered secondary capital. This is welcome news. I'm grateful to staff for the solution and the ongoing effort to shepherd credit union applications through the Treasury process. That concludes my remarks. Do have a couple questions. One is, so just recap, when do credit unions need to get NCUA approval to take advantage of the program? And do you have any advice for credit unions that are still in the process?
Vice Chairman, this is Justin Anderson, and I will respond to that question. In order to take advantage of today's action, credit unions must have an approved secondary capital plan by the end of this year, December 31st, 2021. In terms of advice, any credit union that has not gotten their secondary capital application in should do so as quickly as possible, as we are fast approaching the end of the year. That concludes my answer.
Gotcha. Thank you. So anybody out there listening, we can help, but 2 weeks from tomorrow is New Year's Eve, and that is the end of it. That concludes my remarks. Back to Chairman Harper.
Thank you, Vice Chairman Hauptman. Board Member Hood, I know that financial inclusion has been a priority of yours, and this rulemaking certainly fits in with that overall theme.
It certainly does fit in with that theme, Mr. Chairman. And first, allow me to thank Rick and Justin for your hard work. And again, I want to thank all of our staff for the alacrity in which they were able to get this rule done and get it to the board for action today. And as the chairman alluded to, yes, financial inclusion, as I often say, is a civil rights issue of our generation. And I'm supporting this rule today, first and foremost, because it's our CDFIs and our MDIs that have the proximity to the communities in need, whether it be low to moderate income households, disabled, minority, ethnic, rural, or tribal. They all are there in those areas where people need them, most importantly, especially now during the pandemic. So with that being said, I just look forward for our credit unions continuing to pursue this avenue. I was very pleased that Secretary Yellen did make some announcements earlier this week about EICP funding, and it looks like 46% of the award recipients will be credit unions. And I was very pleased to see that about $3.1 billion will be going to the MDIs. And we in NCUA, as you know, we oversee roughly 500 MDIs. There are more MDI credit unions than there are other MDI banks. So delighted to know that our institutions will be using this tool of sorts to really serve those in need. I have no questions or comments. Thank you.
Thank you so much. Vice Chairman Hauptman, is there a motion?
Yes, sir, there is. This one's a little bit of a mouthful. I move that the board approve final rule part 702 and 741 of the NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion?
I second.
There is a sufficient second. All those in favor say aye. Aye.
Aye.
Aye.
All those opposed say nay. Let the record show that the ayes have it and the motion passed 3-0. Before we close today's meeting, we do have several announcements. First, I know that each board member would like to recognize the people behind several important initiatives at the NCUA. I will start by discussing the rollout of the Modern Examination and Risk Identification Tool, or MERIT for short. Staff from nearly every office have worked together over the last several years to make the MERIT rollout happen. With the core development While the core development was led by staff from the Office of Business Innovation and the Office of the Chief Information Officer, staff from the regions and other offices helped in the development and testing of MERIT. Thank you to everyone that participated in your efforts, and especially to Kelly Lay and Rob Foster for your leadership. Staff from the Office of Human Resources also worked with the core team to develop and present MERIT rollout training that took place between August and November of this year. Thank you to the staff in the Division of Training and Development, as well as the 30 lead trainers and 39 assistance trainers from various offices and regions who helped make that rollout training a success. Vice Chairman Hauptman, I believe you want to highlight the work of those working on cybersecurity matters.
You bet. We talk about cybersecurity a lot at this agency, so the folks working on it are absolutely essential. We talk about credit unions having their cybersecurity game on point, so it's very important that we at the agency have our act together as well. I want to strictly mention some contributors to their outstanding work. a list of folks in the area they work in. Shout out to Jennifer Duncan in Cybersecurity and Program Operations, Jackie Watkins, Security Operations and Incident Response, Kennedy Rodriguez in Merit Information System Security, Raymond Hoffman, Network Operations and Patch Management, George Zhang, Database Security, Al Amin, Database Security, Eric Gunnarsson in Application Security, and Gary Dayton, Security Project Manager. Those folks are essential to an absolutely core function that we're trying to do here. And by the way, it's one that isn't just done and you put it in a drawer. Every single day probably gets harder and harder. So a lot of love to those folks.
Absolutely. Board Member Hood, I know you also want to have some recognitions.
Yes, I want to properly, again, thank all of the folks from OCFO, the Office of the Chief Financial Office, for really the diligence in putting together not only the budget materials for today's vote, but also for our public briefing and also for all the information that was posted in the Federal Register in November. So I know you've often heard us thank Eugene Sheet, who is our Chief Financial Officer. But I want to thank some of his other team members whom we may not get to recognize openly, and that's Melissa Loden, Jim Holm, Susan Douglas, and Eileen Schultz. All of you, yeoman's work, well done, and thank you, especially with a lot of the iterations and the truncated time period that we had to really have a number of moving parts and variables. So again, thank you for your hard work and tenacity, and you've helped us get across the finish line. Thank you all from OCFO.
I could not agree with you more, Board Member Hood. Before we close, I would additionally like to recognize the retirements of 3 key members of the NCUA executive team, Myra Tepe, Joy Lee, and Martha Powell, each of whom I have gotten to know well during the last decade. Myra Tepe retires from federal government with more than 30 years of service, including 10 years at the NCUA, where she served as an associate regional director, and director for the Office of Examination and Insurance. I remember the day that Myra interviewed with the board in 2011, and we have interacted often over the years on such matters as conservatorships, liquidations, and rule writing. Since late 2020, Myra's steady hand has led the E&I team, and I am grateful for her expertise as we navigated the pandemic's economic fallout together. Myra invested in staff development and sponsored an employee resource group, knowing that these contributions to the agency are important components of leadership. Personally, I will miss working with her, and I wish Myra the very best in her future endeavors in Florida. The agency will also be bidding farewell to Joy Lee, who has demonstrated her versatility in her long career at the NCUA. Over the last 35 years, Joy's capable hands and can-do attitude proved that she could master any role that she was asked to take on, including temporarily serving as the head of the Office of Minority and Women Inclusion, the Office of Small Credit Union Initiatives, and the Office of External Affairs and Communications. Since becoming chairman of the FFIEC in April, I have leaned on Joy's vast historical knowledge of the council, and I am so glad that we got to work closely during her final year here. I am grateful to you, Joy, for all of the quiet dedication you have shown credit unions, their members, and your colleagues here at the NCUA, as well as your high standards and expectations for the documents we produce. May you enjoy the many years ahead in Maine. And last, I want to recognize Martha Powell, who has devoted decades of her life to consumer financial protection and the safety and soundness of the banking and credit union systems. Like Myra and me, Martha joined the agency about a decade ago, and the agency quickly benefited from her deep knowledge of banking regulations and policy. More recently, she has served as the Deputy Director of the Office of Consumer Financial Protection. As a result, Martha has worked on issues of critical importance to me and strengthened the protections of members. Martha, thank you for all that you have done as a public servant. I hope that you enjoy a long, relaxing retirement with your grandchildren in Michigan. Now, the NCUA will not be the same without Myra, Joy, and Martha. I hope that the retirements are healthful, long, prosperous, adventurous, and fulfilling. We wish each of you the very best. Vice Chairman Hoffman, do you have any thoughts you would like to share?
Yes, sir. Just a couple comments. One is I want to thank all 3 of those folks for their many years of service. And it's been such a strange time that I've never met any of the 3 in person. I've been at this agency 1 year as of Tuesday. And on a similar vein, all I can say is I hope your retirement can soon be what we all think retirement should be. visiting friends and relatives, traveling anywhere you wish, making use of the time you have. You know, retirees get all the deals for travel. But it's been a strange time because I know some retired people, my stepmother, sitting at home, worried about traveling, not able to travel abroad, worried about seeing people. But anyway, all I can say is I hope you and others have the retirement that you probably thought you were going to have before, and you can do all the wonderful things that your time allows you to do. And we can hopefully put COVID in the rearview mirror. So thank you again for your service, and please enjoy your well-deserved retirement.
And Board Member Hood.
Great. Thank you, Mr. Chairman. And I, too, want to join in just applauding and thanking all of our retirees, Myra, Joy Lee, and Martha. Thank you for your wonderful service and dedication to NCUA. You really have made a difference here. And I just hate that because of the pandemic, I wasn't able to spend as much time with you as I would have liked. Myra, I did get to work with you and your time as the head of E&I, and just thank you for your leadership and all the things that you did to really provide that level of risk and oversight to our credit unions. And Martha, while we didn't get a chance to work together directly, the work that you've done, though, around consumer protection and making sure that all of our credit unions had the guidelines and the guidance they needed to make sure that our credit union members were being treated fairly and equitably. And Joy, of all of our retirees, you're the one that I've worked with both during my time here a decade ago as vice chair, and when I came back, in fact, you were working for the OEAC group, and you helped me a lot with the whole nomination process and helping me with the confirmation hearing proceedings, helping me with a lot of the paperwork. And little did we know that my first week on the job, but then we would get an invitation for me to have a first congressional hearing 3 weeks later. So the fact that you were unflappable and the dedicated and consummate professional. So you really left a great mark, or will be leaving a great mark. And I certainly do want to thank you for all of your support, both when I was going through the confirmation, first hearing, and also let's not forget FIFIAC. As the chairman said, you are that institutional knowledge, and I know he's relied on you as much as I did with FIFIAC. So with that being said, have a wonderful restful retirement in Maine, and the rest of you together, I just hope you get to do, as the vice chairman said, do what we think of retirees doing, having fun, going on traveling, going to Vegas, all those other fun activities. So thank you all, and I hope you have a wonderful holiday with your families as you usher in a new chapter in your lives.
Thank you,
Mr. Chairman,
everyone.
I'd like to add one thing.
Oh, absolutely.
Yeah, just one thing. A separate shout out. I saw this article today in American Banker. Just want to give some love to a few credit unions in Kentucky who are helping people out after devastating tornadoes. Just read today about a tiny credit union called Your Hometown Credit Union in Mayfield, Kentucky, a town that appears to be almost entirely destroyed. The town's very existence, is in doubt. The credit union CEO said he had 6 employees. 3 are working keeping the credit union going. The other 3 are delivering meals and water to those whose homes were destroyed. Just a nice example of, in a brutal time, of credit union folks doing what we think credit union folks will do. That is all. Back to you, Mr. Chairman.
No, thank you. And thank you to everyone. That is the end of our agenda today. Before I close, I do want to express again my deep gratitude to my colleagues on the board as well as their outstanding staff. I also want to recognize the truly outstanding efforts of the agency's Chief of Staff, Catherine Galicia. She is an unsung hero who works behind the scenes to help us reach consensus and keeps things moving smoothly forward. Together, we have accomplished a lot this year. We have worked together to solve tough policy problems and forge consensus on many matters. I am grateful to the relationships that we have developed over the last year on the board, and I look forward to seeing what we can accomplish together in 2022. With that, I wish everyone at the NCUA and everyone listening happy holidays. There being no further business, we are hereby adjourned.